February 24th, we had a live session here on, a bear market and how we could possibly be going on a bear market. Well, I'm glad to say the exact time when we posted that video marked basically the what you could say is the start of the bear market, and officially we kind of got the top on that one. So the timing was impeccable. And the funny thing was, when I posted that video and when I, put all that information out, I got a lot of messages of people hating on me because they didn't like what I was saying. And what I thought was important was to shove it in their faces and to talk about what we talked about last time very briefly and go into the important things that were, covered on last time. And now we're going to talk about, how correct were we, what we can do to prepare for upcoming whatever it is, whether it's bearish or bullish. We're going to talk all about it. So this is bear markets for dummies. Before we go any further, feel free to take a screenshot of this. Feel free to pause the video if you're on YouTube. This disclaimer just talks about how we are not licensed professionals. Everything we say is just strictly opinions and for educational purposes only. If you want advice, please go consult a trained professional or a licensed professional, right? But we are not professionals, and this is just all strictly opinions and for educational purposes only. Everything I've done here is based on my past experience and extensive research that I've done. So this whole topic, and when it's come to bear markets, I have a pretty good idea of what I'm looking at. I've personally been through three of them, 2018, 2020, 2022. Even though there was many more bear markets beforehand, I've done hours upon hours on bear market research. Today itself, I did probably 6 hours of research today. So, yep, everything mentioned here is based on research and personal experience. So the funny thing was, last time we had this live session, I started off with the sentence, is a bear market happening now or soon? We talked about, there were some signs such as SPY and QQQ running low on steam, multiple instances where huge sell orders were filled during the day, and TLT was starting to turn bullish. Back then, this is how the chart looked like, then we'll get into how TLT looks now, which is pretty funny, but if you guys remember, I talked about how I got into TLT leaps, and this is what TLT looked at on the time we did the recording. All right, and I talked about how it performs well in bearish markets. Low beta stocks such as Coca-Cola, Pepsi, PG, and so on, like the safe havens, were performing really well back then as well. If you guys remember, we got those Pepsi calls that went 800%. You can see how Pepsi performed there. Coca-Cola is performing well after earnings, and PG was doing pretty good as well, even though it had this massive sell order based on news, but it reclaimed all of it. High beta stocks that were not performing well were such as Meta, Avgo, and XLK. You can see XLK, which is the Spider Tech ETF, which tracks all the tech stocks in the S&P 500, were all what's it called? We're all, the XLK was just completely bearish. It started melting down. Avgo itself was also melting down as well, and Meta was melting down. The funny thing was, when I went over this, I don't get why I got so much hate. I guess people did not want to see that we were going to head into a bear market. But if you guys listened, I'm proud of you. If you didn't, I don't know what to say. I'm sorry for you. But all right, implied volatility was also increasing. VIX was increasing at that point. You want to know what the VIX looked at like right before then? Look at this. This is how the VIX looked. VIX was at 18. On Friday, VIX reached 45. VIX broke this dumb painting, little trend line that I drew and smashed all the way up to freaking 45. So I gave you guys all this indication, and I've been flooded with messages. In fact, today I was not going to even do a live session, but I was so over flooded with messages for one-on-ones and all these questions about, portfolio management and how to trade. And I'm so down on my calls that I just realized, like, hey, even though I did this live session already, maybe I need to go a little bit further and kind of drill into the heads of people who did not listen. And for those who did listen, maybe there's some other factors you want to pay attention to. So again, we're going to do an overview of what we talked about last time. We're going to skim through it. I'm not going to go too detailed about that stuff because we covered it in our previous video. You could watch that again if you want a more detailed explanation. But I'm going to skim through this, and then we're going to go into new parts that where we evaluate some of the previous bear markets. So bear markets are not the end of the world. Regardless of the past recessions, we're in a different times now, right? You'll see that in the examples later on. New types of reactions, because not everything will be the same. We have more volatility, we have more retail traders, we have more safety precautions put in place. There's a lot more that's changed. Too much money is in the market, which means strength will show or there will be a potential breakdown. And as we've seen, the fact that there's been too much in the money in the market has shown that there's actually a lot more possibility of a further breakdown, right? We've seen that on Thursday, we saw that on Friday. So this, right, too much money means not only from retail traders, but foreign central banks. We talked about how foreign central banks have been piling their money into the US equity market, which is a good thing, but at the same time, very fragile. Because if they start withdrawing their money, then we're talking about loads of money escaping from the equity market. So unfortunately, people would think it's easy to get rich because in a bear market I could just get puts, right? And you think you would just get puts and you'll be fine on the way down, whether it's, just day trades, whether it's swing trades or a hedge. Matter of fact is that's not true. Majority of traders quit during a bear market because they've tried that so many times and it just does not work. It will work a certain set of times. I'm not gonna, deny that. But there's also the reality that you're trading in a high IV environment, which reduces the success probability of puts, not only for hedge, but actually for day trades and swings. And we'll get into that in just a second. Why is it harder to trade in a bear market? Implied volatility is the biggest reason, and you should listen to this because I talked about it for so many months and no one listened. Not okay, let me take that back. I'm not going to be a douche. Not a lot of people listen to me, so please pay attention. Volatility typically increases because of high level of fear and uncertainty, right? That's what a bear market is. When there's a lot of uncertainty and uh, you know, fear, you're going to get massive sell-offs. And because of that, volatility increases. So IV always increases during a bear market. This is because it makes it harder to do the following. It makes it harder to swing puts and to day trade puts. Option premiums, which is basically the price, increase as well. This is because, the IV is increasing. So because the IV is increasing, you get an increase in option premiums. IV crushes are more common. Let's say, for example, we had, Thursday, Friday came, the IV on contract was so insanely high. It is crazy. Maybe you guys don't observe the option prices, but I am really analytical and observant on how the option premiums move. And if you looked at the SPY and QQQ premiums on Wednesday compared to Friday, we're talking about 2 times to 3 times more expensive than the average option price. So IV crushes are more common because you're gonna have days like Thursday and Friday, and then let's say tomorrow. This is why I was saying it's completely pointless of looking at the futures market and looking at all the headlines now, because everything can completely change overnight or everything can say the complete same. It does not matter. What's the point of becoming irrational by panicking yourself and looking at what's going on instead of just thinking, hey, there's nothing I can do about it. Let me sleep and wake up tomorrow and deal with it, right? So if you guys are paying attention to that, I'm saying this from the bottom of my heart. I know I sound harsh, but that's just how I speak when I'm passionate about things. Turn it off. There's no reason to look at it. Unless you're trading futures, which if you are, may God bless you. I hope your account doesn't get blown. But there's no point of looking at it now because you might as well get a change tomorrow. And the reason I say that, and I'm going to keep it very simple, and we're going to dive into it later, is because if you have two consecutive massive sell-offs, there's of course a probability you're going to have a continued sell-off, which we're going to get into an example as well. But there is a bigger probability of somewhat of an IV contraction. So those are, complicated terms, but again, we'll dive into that in a little bit. But please, if you're watching it, if you're panicking, there's no reason to panic. Might as well just wait till tomorrow, especially since you guys have options in stocks. What's the point of looking now, right? Reaction times are decreased is because a lot of things are volatile, so you need to make quick judgment choices. This is what eventually flushes out all the hesitant traders. For those who look for confirmations and stuff like that, you're gonna have a lot more problems here and a lot more trouble. So you need to make sure you kind of do a lot more research and observe what really works, and then go based on that, because reaction times are going to become slower and not slower, smaller. Increased market manipulation. This is just a fact. Everyone's going to look out for themselves, and that even counts banks, hedge funds, whatever, whales. They're not going to be looking out for you. So they're going to keep on putting themselves in places where they can get the most liquidity, where they can, profit off the most, or just at least cap the amount of risk and downside they have. Timing becomes more important. This kind of ties into the reaction part. Chasing breakouts and breakdowns are much harder. This is because there's a lot more ranges in a bear market, and you'll see what I mean by that in an intraday basis and also swing basis as well. So, chasing breakouts and chasing breakdowns can sometimes not work, especially breakouts. Indicators start losing value and are harder to read. This is especially true for the RSI and MACD. And news and macro events hit harder. And I hope when I said this on February 24th, you guys listened to me, because previous to that point, all the fake reports and all the bad bearish reports that came out just did not impact the market as much. Literally, like, an event can come out, the market will be down before February 24th, and then after that, the market will open, and then it will just skyrocket. And it's like as if that bearish economic data came out, didn't matter. What's happening now? If we get any bearish data, we're just freaking going down. Like, there's no buffer like there used to be. So I hope you guys really listen to that point. Price action bear markets. Oh, this is ugly since I drew over it last time. Ignore all these white arrows. So maybe I'll just delete all of this. But this is what an intraday chart usually looks like in bearish markets. And the funny thing is, if you guys were here during February 24th when I went over this, if you look at Thursday and Friday, even though they were both sell-off days, this is exactly how it looked like. And the funny thing is, there's nothing changed to this drawing. So realize that a sell-off just doesn't happen just in one shot. It's not just a straight shoot down, right? The chances that's happened before, or the probabilities happen, is just very slim. We've had few outlying cases where that's the case, but you can see all the times where there's a steep drop-off, there's always these massive run-ups, right? Or these short covers, right? So just keeping that in mind. You can't just buy puts and be okay with it. And because of IV increase, right? Since the IV is increasing, think of like this: the IV increases on the drop down, which inflates your option prices, and then the second the price bounces, the IV decreases, which means even if you get puts and you got it all the way here on the top, because the IV decreases on the way up, your option premiums get a bigger hit. So the price can be way lower than when your entry point was for the puts, but just this bounce here is going to take away so much of your gains. So that's why it's actually problematic to trade puts in the scenarios, right? So you have to be really, really concrete with your entries and your trading plan. It's no time to be a loser here. Like, you have to stop slacking, and you have to pay attention to what you're doing. So keep that in mind, right? Imagine the chart price and just imagine volatility as well. When there's a sell-off, you're going to usually see an increase in volatility, and when there's a run-up, you're going to see a decrease in volatility. That's just the usual way this works. Drops are sharp. Wow. Drops are sharp. Wow. Drops are sharp, but is often met with very aggressive bounces. Reaction time is shortened because bounces and rejections happen quickly. Regardless of this, there's still a lot of chop and range in trading. And as you can see, this is what I mean. What does range in trading mean? Well, just keep it very simple. If you were just answer like this: if you were to buy an option, whether it's a call and a put, and you were to buy in the beginning of the day and then look at it in the end of the day, if your option price is closer to your entry point, then that's a range, right? You're basically just in the whole day was just wasted in a range. Or the IV was just in a range where it just kept on killing and gaining your option contract, where you're just getting out with little to no profit. So that's what you want to look at when you think about range. Range is not always just, range doesn't always go like this. You don't see these kind of ranges anymore because there's too much volatility in the market, because there's a lot of more retail traders, a lot more money in the markets. So ranges are no longer like this. They're now like this, right? They go down, they go up. This is what our new definition of a range is. So make sure you pay attention to that. Let me make sure, one second before I continue, let me make sure I'm streaming to Twitter. Okay, cool. Yeah, I am. All right. Let me take a sip of water and we're going to continue. Swinging and day trading. Since IV is high, timing is very crucial for option traders. Option prices are higher, which increase risk. The reason why that is because obviously if you're paying for an expensive contract, you need it to gain value pretty quickly, right? Because if it's not gaining value, then remember everything reverts to the mean. I talked about mean reversion before, so that applies to IV, that applies to option prices. So if something's very overvalued, it's going to eventually come down to being fair valued. So remember, since options are more expensive, you are dealing with more risk. Please understand that a bear market is not safe. You are dealing with more risk on a bullish day and a bearish day on every single given day in a bearish market. You're dealing with higher risk, you're dealing with higher volatility, which means you're dealing with higher IV, which again means that you're dealing with more expensive option prices. Breakdowns and breakouts trades have less success. Theta is a bigger factor because of the chop and the range that we talked about before. Was especially what's it called? This is especially due to especially certain for zero DTEs. So those who are dumb enough to trade zero DTEs, keep that in mind. There are going to be a lot of false bear flags to cause short squeezes, then breakdowns. I guess I thought I had a drawing there, but what I mean by is, wait, let me read that again. Be a lot of false. So what you're going to probably see is like bear flags like these, right? When you're carrying bear flag, you're making lower highs and stuff like that, and you break down, and then immediately when it breaks down, you start shooting up, and then you reject. But since you bought puts over here for the breakdown, the second this bounces, your option premiums are just going to get killed on the way up, and you're going to be coming out with a loss instead of a break even or anything like that. A common put scenario, this is exactly how it goes. You would take a put as a swing because of an H pattern, for example. The next day, the stock is down 1%, 5 seconds before open, right? Negative 1%. Once the market opens, even though the stock is down 1%, the opening price action is followed by a strong short squeeze. Depending on the strike expiration in IV, your contract will either be break even or a big loss. I cannot tell you how many times if you were to look at the previous stock crashes and you look at the bear markets and you look at the stocks, individual stocks, and even ETFs, there's a lot of time where H patterns form. You get a breakdown and the next day it's like you're down, the stock or ETF is down -2 or -1%. But before you know it, the market opens, it dips down for just a second, right? It dips down for just a second. But during that second, you're waiting for your option premiums to update, right? To figure out what the proper price is. And before you know it, not even 5 minutes in, you get a short squeeze to the upside. This is why I'm saying it's completely irrelevant to even look at the futures market right now. There's just no point. Because even if we're down 5% tomorrow, yeah, of course, that's down a lot. But there's also a probability you can get a drop down and then an immediate short cover to the upside. And also the same thing, you can even see the market being up 1% tomorrow or down and then immediately dropping, or seeing the market down 2% tomorrow and then it's down like 5% in 5 minutes. So it doesn't really matter what's going on right now. Like I can't emphasize that enough. Just wait till tomorrow. The reason why I'm saying that is because if you look at now and if you look at all the headlines now, all that's going to do is if you're already in stupid positions, or even let's say if you're in logical positions that are going to be hurt by this, you're just going to have a lot more panic heading into tomorrow. And there's just no need for that. That's the last thing you need. You need to have logic, you need to be smart, and you need to deal with things in a proper way. Sorry about that. My dogs were playing with each other. Indicators lose value, right? Common indicators such as RSI and MACD lose value due to chop. You're going to see a lot of times where things are going to show as oversold, and it's not going to end up bouncing, so you're going to get screwed on that point. Moving averages and VWAP, though, hold a little more value. And you'll see this if you actually guys have been following my trade ideas. You'll see for any of the charts I post, You will see now that I'm back to using moving averages. Moving averages was one of the first indicators I ever used when I first started trading. They were always a phenomenal indicator to use because they're viewed as dynamic supports and resistances, and you can also look at them as like a sentiment kind of reading thing. But moving averages hold a lot more value because it's a lot more commonly viewed at. And maybe it's something you might want to keep an eye on versus something like the MACD and RSI. News and economic events, we already talked about this. These hit harder because of the amount of risk and uncertainty, because everyone is so fearful. You guys probably, if you're on Instagram or Twitter, seen all the posts that are, oh, we're at 4 on the fear index, right? So everyone's like, if the second they see bearish data, everyone's just freaking, you know, selling off their stocks and stuff like that. So these are going to hit a lot harder. If Trump gets diabetes, you're going to see the stock market go down 8%, or it could go up freaking 8% because everyone's so glad that he's not talking about tariffs anymore, right? But if he increased tariffs, which is so funny, we talked about this in February and he did increase tariffs, the market's down, right? So again, I talked about this before. I really hope you guys listen to this. Market manipulation. Short-lived aggressive short squeezes are more common. This is because hedge funds, institutions, banks are all covering their shorts, so these are a lot more likely. This is, as I said over here, this works for them because traders in shorts panic easier when seeing bullish reversals. You guys know this. We've always talked about how bullish setups in any given market have a higher probability than a bearish setup. And that's still somewhat of the case in a bearish market. But, anytime you're because of that, anytime you're in a put or in a short, those kind of traders in those positions are more likely to exit their positions the second they get just a little ounce of invalidation. So this is why short covers, lead to a lot of manipulation in the stock market. Bear markets are hard, but not impossible. Credit spreads are extremely efficient. I cannot stress this enough. There's a few people who listened, and I'm really proud of the guys who did. The guys who've been doing credit spread and iron condors have been extremely profitable the past 2 months. The people who haven't have been having mixed results. Swing trades will become less of a go-to compared to day trades. I mean, you guys have seen this. Even though I still swing trade, that's just because I'm really good at it. But you could see I put a lot more emphasis and on the on the day trades, right, compared to swing trades. Before I didn't used to swing trade as much, but now you're seeing a lot more of my day trades. And it's not because I can't day trade. I can for sure day trade. Let's just say I'm too lazy to day trade on a average basis. So that's why I usually tend to swing trading. But since I'm in a bear market, I'm not just going to let my laziness get the hold of me. I know I got to day trade because I don't know. Wait, hold on. Let me take that back. I know I would rather day trade to make my profits versus swing trading because the risk is less on day trades versus swing trades. Unless you're a complete idiot and then you oversize on day trades, then of course your risk is the same for both. Educate yourself and learn more. A bear market is not a time where you just sit there and just open the computer when it's market open, turn off your computer at market close, and then repeat and rinse and repeat. And then you just don't learn anything in the time in between. You need to learn stuff. You can't just be stagnant. If you are, you're going to see your portfolio just wash away. Whether it's long term, whether it's swing trades, whether it's day trades. If you're not learning, I am telling you, I've been here on Discord for 8 years. There's a reason why in 2018, when we had the correction, all those Discord traders that were back then are not present now. 2020, same thing, pandemic crash. 80% of the people who were there as Discord traders in 2020 are no longer here now. 2022, 90% of the Discord traders that were there are no longer here now. Why is that the case? Because people are not learning more. They think they have something great going and they completely forget about the fact that there's other possibilities past what they can imagine. And when shit hits the fan, they don't even know what the heck is going on, right? So learn more, learn things. We have so much content on our YouTube. We have the VIX stuff. We have JP's gone over and done a phenomenal job on other, content stuff there. We have a risk management video. Like, there's so much you can watch. It doesn't even have to be from us. Just make sure you watch make sure what you watch is not flashy, right? In fact, the boring videos that span for an hour or 2 hours long from old people or, former hedge fund managers. Those are stuff you should be watching, not the stuff like, hey, I made $20,000 on QQQ. Watch how I did it in 15 minutes. No, that's not what you look at. You look at stuff that have to do with market manipulation, market structure, volatility increase, volatility contraction, expansion. There's so much you guys don't know, and you have to learn these things. Backtest and observe. Very easy to do. If you do have Thinkorswim, you can do this easily with the on-demand feature. If you have TradingView, you can go back in the chart and you could see what works for you, right? What works during certain different days. Today what we're going to do is going to go over like a few charts from the bear markets back in 1987, 2000, 2008. This is stuff you guys should be doing. I'm only doing this so you guys can, there's no reason for me to do this live session other else than the fact that I feel bad for you guys. All right, that's just completely honest, because I would have pushed this till tomorrow. And if tomorrow, whatever outcome comes, you guys would be missing out because I ended up being lazy and did the live session tomorrow. So the reason I'm doing this is to benefit you guys. So I'm hoping this live session kind of gets you out of your lazy rhythm if you are in one and you are proactive and kind of trying to observe and learn what you need to be looking at. Sizing with caution, I cannot stress this enough. Whether it's day trades or swing trades, you're not in a risk-on environment. You're on a risk-off environment, which means you should be doing the same thing with your trades. Bear markets are not for you to rapidly grow your account. Bear markets are time for you to preserve capital, grow slowly, and fight inflation. That is your main objective. You could also say your main objective is to survive. You're not trying to survive, you're trying to thrive, right? Wait, no. Wait, I butchered that. You're not trying to thrive, you're trying to survive, right? So realize the difference between both of them. It's very important, and we'll get into that. Put more value into the bigger time frames because it kind of helps you reduce the noise and clutter. If you are a person who has too many, oh my gosh, my dog's going crazy. If you're a guy who has too many levels on your chart, maybe you want to just reduce the amount of levels you have and just focus on the important ones. Be informed about economic events. If you have no idea what's going on, be in the know. You have resources such as any AI, whatever, Grok, ChatGPT, Gemini, whatever, right? DeepSeek, if that's still a thing. I don't know. I've never used it. You can ask anything that seems intricate to you. It takes 5 seconds to type something and 5 seconds for it to reply back to you. So definitely, get in the know of what each economic event means and what the results mean as well. I personally like Grok a little bit more because it's a little bit more up to date than certain other AIs. Reduce the frequency of trading. There's no reason you need to trade every single day. Some days will not be a great day for you to trade. On Friday and Thursday, I cannot tell you how many people got liquidated out of their option accounts. Options. I'm not even talking about futures. I have so many messages because I'm in so many servers telling me, hey, I lost this much money, I lost that much money, I'm quitting trading and stuff like that. And these were not even from my trades because my trades were fine, right? Unless the people oversized on the SMG and the, the ANF trade. We did fine in our trades, but a lot of people who took their own individual trades, even if they were right initially in what their sentiment was, their oversizing caused them and their overtrading caused them to be in a bigger loss than what they should be. If you're in a loss, if you're swing trading, for example, and you're down on the day, you shouldn't be trying to regain your losses. That's the dumbest thing you'll possibly do. Don't try to trade to regain losses. Trade because there's something in front of you that you know would make logical sense for you to trade. So how to prepare for a bear market. This is now the new section which I wrote today. This is the extended version. So we're going to go over how you can prepare for it. So we called it perfectly and to the point. If you guys actually go onto your trading views after this live session, you go and you check exactly on February 24th, because I have the timestamp here for when I did this live session. February 24th was the mark of when you can actually say the bear market started. And you could see that was almost literally the top. And everything we said, everything I said about which stocks will perform and which stocks won't, came out to fruition, right? Came into reality. Don't worry. Just like the stock market has circuit breakers, hopefully this live session is an account circuit breaker for you. So if you're in an extreme losses, hopefully this kind of jogs some juices and, gets the brain working and makes you think of alternatives to what instead of the other habits that you're used to doing. Again, not financial advice. All right. So where are we now from when we last talked on February 24th? Let's take a look at the high beta stocks that I said will underperform. The SPX, which is basically SPY, is down 15.19% from the day we talked, right? All of these are from the day we talked till Friday. NDX is down negative 18.5%. DJI, which is the Dow, is down 11.9%. NVIDIA is down 29.19%. Meta is down 27.5%. Amazon is down 21.85%. Tesla is down 28.6%. And IWM is down 18%. All of these listed stocks, if you were to go back to the bearish market video that I talked about, all of these were the stocks I said were going to underperform the most. And look at what we have here. Well, don't worry. I mean, not don't worry, but I didn't just leave you with what's going to underperform, because anybody could tell you what's going to underperform in the bear market and they'll be right. What makes the person right that you're listening to is if they tell you the stocks are going to perform better, then the stocks are going to underperform. And then then the person you're listening to actually knows what they're talking about. So let's talk about the stocks I did talk about, which are the low beta stocks. Coca-Cola, only down 0.93%. In fact, if you exclude Friday for all of these stocks, Friday and Thursday, Coca-Cola was almost close to, was it almost close to all-time highs, or was at all-time highs? Coca-Cola was up extremely high. So was Pepsi, right? Pepsi's only down negative 3.87%. PG only down negative 3.8%. And TLT, which again, if you exclude Friday, will be up a lot more, is up 4.70%. So you have to also focus, you have to expand your horizon to just the stocks like Tesla and ETFs, to stuff that are considered safe havens because they perform better on a day-to-day basis during a bear market, which means the setups you look at are less likely to be invalidated. Whether that be a put setup, whether that be a call setup, safe havens have a higher probability of whatever you're looking at to work out. So safe to say, we called the top and pick the correct stocks again, because I did the same thing back in 2022 and 2020 in live sessions. So it's nothing new that we did here. So setting expectations is the most important step that you need to do when heading into a bear market. Majority of you were wrong about your sentiment and have torched your accounts. So it's safe to say that you should probably think that, okay, if I was wrong about that, then your current expectations of your account growth and everything could easily be wrong as well. Again, I know I sound harsh, but this is because I care. Quiet your mind from whatever your previous thought was, and listen to when I say your goal right now is to survive and not to thrive. Okay, that's what I meant to say earlier. Your goal right now is to survive and not thrive. I mean that with every bit of me. If you have only been trading for the past 2 or 3 years, in fact, some of you guys have only been trading for less than 2, your account focus right now is not to freaking grow your account. Your focus right now is to survive the bear market, fight inflation, and be there for the bull market that follows the bear market, because the bull market that follows the bear market is the best time to grow any sort of account, whether it's a small account, medium account, big account, long-term account, whatever it is. If you are there for that bull market once the bear market is done, you are set. And you don't even have to find the bottom of the bear market to thrive once that bull market starts, because you'll see actually I didn't show in the examples, but I'll pull up my trading view chart afterwards. You will see how amazing the stock market is and rewards those who are safe and smart and survive the bear market, and how rewarding it is afterwards. So please, even if it means you had to be a butthead and just be patient and wait for your setups, or not even trade during this era, wait till the bull market comes, or survive till the bull market comes, and you could find the things that help you grow your account to the goals you wanted to reach. But all those goals you have, even if you're in losses now, you have to ditch those ideas, right? You have to ditch those goals that you have. Until we're back in a bull market, you cannot expect yourself to reach those goals, right? You have to relieve yourself of the unfair expectations, because that is what will kill your accounts. I say this because this is literally what happened every single day in 2018, in 2020, in 2022, because those were the 3 years I was actually on Discord. All of those times, people got into losses, or they were even fine. They didn't even do anything. Their accounts were fine, but they were like, "Oh, I want to grow my account, 8%, or 8%, 10%. I want to grow 100%. I want to reclaim the losses I had." Unfortunately, those people who were, some of them were such good people, ended up losing their accounts and they just quit trading. And the losses sometimes that they put themselves impacted their financial, stability. So please realize whatever money you have in your trading account is your hard-earned money. A bear market is not the time where you go balls deep, risk on, and think everything's gonna work out. No, you gotta be tactical with everything. Doesn't mean you have to be a wuss. I'm not saying you have to be a wuss. Do you see me being a wuss? No, I still take my trades. I'm just a lot more logical. I don't size as heavy as I used to a few months ago. I'm a lot more lighter size. In fact, I care about you guys, so that's why I say, when I size light and people get like, I don't know why some people get so furiated. They're like, oh, you size light and you said you size light and this trade went up 300%. How dare you said you size light? I size light because of you. But now, like, look at me now. I size even lighter on my positions, and sometimes it helps people, and sometimes people ignore that. And that's why on Thursday, even though the tariff event happened, my account actually went back in the green after our day trades because I sized small on my swing trades. I sized light, and then the day trades, even though I sized light, they were good enough where it reclaimed a lot of the account value. So the day trading account was up. On Friday, our account was mega up when everyone's account was down. And you could see, I posted the pictures. I'm pretty honest with you guys. I posted a picture of my account growth for one of my accounts. It wasn't anything spectacular. It was just 5% on the day. But if you go back to the when the market was bullish and I used to post those account growth, what was the numbers? It was always insane numbers, right? It was insane. It was like 10%, 14%, 19%, 8%, right? But why was those numbers so high? Because I sized higher, right? I sized bigger, sorry. And it was a much more of a risk-on environment. But realize we're not in a risk-on environment right now. You have to be a lot more tactical with what you do. And I'm telling you, one of the biggest things that could help you is your sizing. So if you haven't watched the risk management video, watch that because that could lead you to help you figure out what you want to do with your sizing. So you have to understand there's different types of bear markets. There's not just a bear market, right? You can't just say bear market and that's just it. No, there's different types and there's different ways these react. Different time frames, different I wouldn't say frequencies. I guess you would say like just how strong the bear market is, how short-lived, how long-lasting, how violent it is, or how somewhat not violent, but just like, whatever. I can't think right now. English is not my second language, so wait, oh my god. English is not my first language, so bear with me. All right, the first one, cyclical bear market. This is tied to economic cycles and lasts for months to years. An example of this is a 2007 to 2009 global financial crisis. This was driven by recession. You guys can remember, if you guys probably already watched the great movie of The Big Short. There's another great movie that unfortunately a lot of people have watched. I keep on forgetting the name, but it has to do with a bank. And it literally, almost the entire movie takes place in a bank. And it's like this guy who gets fired made a model that predicted the crash. And the reason why that movie is really important for you to watch is because it shows, it's not fully accurate, but it shows, oh, Margin Call, thank you so much. Yes, Margin Call, that movie is spectacular, and I personally like that a lot better than The Big Short. The Big Short is a nice, entertaining movie to watch, but the Margin Call is a lot more informative because it shows you that these guys have, even the guys who have so much money, who have all these models, are still so greedy. They're so dumb. This is why you have no idea how many whales have approached me over my course of years of trading and have told me to trade their accounts or join these kind of groups where they talk to each other or they say, hey, come join me. We'll trade together. We'll split profits, all that. I reject it because sometimes you have to realize just because people have money, and this involves banks and hedge funds and institutions as well, does not mean they're always smart. This is why bear markets happen. 2007 to 2009 was caused because of idiots who had money. We had a we had a Fed chairman who kept on saying things are going to be great, things are going to be fine. There was also another great movie, and you guys have to remind me of this. There was a movie which had to do with like the bank CEOs meeting with like this guy in the government, and they had to like there is talking about like bank buyings too big to fall. Thank you. Yes. So if I were you guys, a movie you want to watch, two movies you want to watch is Too Big to Fall and Margin Call, because I'm pretty sure all of you guys have watched what's it called? The Big Short. Big Short. I wouldn't say it's the greatest movie to watch because it just kind of shows what happens and says the stories, and that kind of might lead you to do a little bad habit because it kind of talks about people who have big balls who did risky trades and ended up working. Um, but the great movies that you can actually learn from is Too Big to Fall and Margin Call. And the reason I say that is because those movies show you that just because people tell you it's fine, or just because people tell you things are going to go into chaos, doesn't mean they always know what they're doing, right? I could be wrong. You could be wrong. Jim Cramer is wrong 90% of the times. Trump could be wrong. Even Jerome Powell could be wrong. It is up to you to learn and to digest everything that's going on, and for you to come up with your own opinions. Because I'll tell you this, I am very thankful that I was in my 12 years of trading. I'm thankful that I was so idiotically stubborn that I listened to nobody, and every time I was wrong, it was because I was wrong, right? And because of that, I was able to learn from it. And because I was wrong, because of my own losses, I already had a plan. Versus if I were to listen to somebody else just because someone says, oh, the stock market is going to crash tomorrow, or oh, the stock market is not going to crash, we're absolutely fine, and then you follow them. This applies to people who have platforms, Discord traders, even me. If you just follow them blindly, what you find yourself is you find yourself in just scenarios where you don't have a trading plan, and then you're screwed because you don't know what to do when you're in a big drawdown for whatever trade. So definitely listen to yourself, and the only way you can listen to yourself is by educating yourself, because you don't want to listen to your retarded self. A lot of you guys don't have the knowledge yet, and again, it's nothing against you. I know a lot of you guys are new to trading, but I will blame you up front if you attend this live session, you do nothing about learning. So learn, understand what different economic things mean, understand technical analysis, understand economic driven things, and then you'll figure out. So I just went on a complete rant, but watch those two movies. They're really great. So cyclical, right? Tied to economic cycles, last for months. 2007 to 2009, that was the global financial crisis caused by the housing market and so on and so forth, and the recession. Next one is structural. This is caused by deep systematic issues that last for years. A great example of this is a dot-com bubble, which lasted from 2000 to 2022. This was because of tech overvaluation. This is because people were just buying tech like crazy, similar, listen to this. In 2000, 2002, people were just buying companies that were just not even profitable. And they were just buying it because it was tech. Because the World Wide Web was just growing and everyone was just, ecstatic, and they're saying it's the next big thing. And it did become the next big thing. But all these companies that were not profitable were so inflated that once people started realizing it was a dumb thing, the stock market crashed. And you could kind of relate that to kind of today, where you see all these AI companies which don't even make freaking revenue, like Oklo, I think, right? Oklo doesn't even make any revenue, or IonQ, I don't know if that makes revenue. And people are just buying it up. Even companies like Palantir, which has revenue and is an okay company, still is very overvalued. HIMS, I guess that's not an AI company, so we don't need to talk about that. Event-driven bear market. This is sparked by a sudden event, often short-lived. Obviously, the second I say this, you guys should think of the pandemic 2020 crash. That was very short-lived, right? You could kind of think of the August flash crash from last year, but that was not really a bear market. So the 2020 COVID crash was what you would want to look back at. Speculative bear markets. This follows a burst bubble from overhype. You can technically, I mean technically the dot-com bubble is under this criteria or this type of bear market. But another example is the 2018 the 2018 crypto crash, which happened after like Bitcoin went from an insane number of I think like 400 to 18,000, and everyone started piling their money in all the crypto coins and whatever, and then after that just completely crashed, right? So whenever you form a bubble, which Bitcoin did, you end up having a speculative bear market, which is very deadly. And you saw it took a while for crypto and Bitcoin to recuperate from that kind of bear market. Now, secular bear market is something we have to hope doesn't happen. Secular bear market is a long-term decline which lasts for decades, uh, usually because of stagnation, which causes stagnation. A great example of this, unfortunately, is 1966 all the way to 1982, where the U.S. equity market was stuck in a range for, I kid you not, 16 years. Did you hear me? 16 years where the market was stuck in a freaking range because of inflation and stagflation. So if the market reaches a secular bear market, we are going to not be in a great area. And the reason someone said is that isn't that a good thing? The reason why it's not a good thing is because once big money realizes we're in a secular market, there's going to be less growth, there's going to be less investments, which means there's going to be a lot of less valid setups. So it is not a good thing. Secular is not a great thing at all. And yes, 2018, we'll get into that related to Trump. Correction. The correction is basically where you have a short-lived, mild drop. It is usually 10 to 20%. Bear markets usually consider a bear market when it reaches 20% and onwards. But I like to include corrections in here because you need to be able to distinguish a difference between a true bear market and just a correction bear market. Example of this was obviously what you guys mentioned right now, which was 2018, which was caused by Trump because of trade war fears, but it did have a very quick recovery. All right. Trump's first term. We need to look over this because Trump is in his second term now, so history often doesn't repeat itself, but it often rhymes. I keep on butchering these sayings just because I'm so thirsty for water. Trump had two bear markets in his terms, right? He had 2018 correction, and he had the 2020 event-driven bear market. Remember that. So for all the people who thought that Trump's going to come in and give us the most bullish stock market ever, I mean, even if you guys are Trump supporters, you have to look back at his term and realize he gave us two pretty drastic bear markets. And of course, you can't just say like, hey, COVID was Trump's fault. But of course, the things that he did led to certain things. And the government, of course, is not just Trump. The government and all our different government parties caused different things. So just remember, Trump had two bearish markets in his term. Just keep that in mind. Sectors had the same reaction previously to what they are having now. So high beta, just like before, had very sharp sell-offs, especially tech. So Nvidia, Meta, Netflix, Dell, all those things. But I've been talking to you guys about this for a long time now, before Trump was inaugurated and after Trump was inaugurated, and a lot of you guys listen to me. I'm very thankful. So I don't seem like an idiot or crazy whenever I talk about these things. But there's some unique stocks that thrive in those bear markets, and you're going to hear them and you're going to be like, oh my God, Kevin, you never stop talking about them. Well, yeah, because I gave you guys the absolute bottom for both freaking stocks. That is going to be Baba. Baba in 2000, from 2016 to 2020. So in Trump's term, gained 438%. So if I zoom into this chart, you see the bottom was all the way down at, let's say, we'll even make it $70, and Baba surged all the way to 310 and onwards. That is a 438% gain in 4 years. I did the same thing in 2016 that I did this year and last year as well. I loaded up on Baba, and it was a massive rewarding trade that I had. It was for my long-term accounts. It was even for my swing accounts. It was just amazing, right? Trump loves China, he loves China so much. He's the type of guy who has all these trade wars, but China ends up benefiting from it, right? You guys can go see Baba now. Where's Baba? I gave you guys Baba 4 months ago. Where's Baba now? It went all the way from $80 to 140 or 130, wherever it went. I keep on forgetting. But the next stock, of course, is the one I've been talking about, which is Baidu. Baidu has gained 154% from 2016 to 2020. This, of course, it didn't perform as great as Baba, but it did have its surges, in the time period where Trump was, president. So in the beginning phase, it went 103%. It did have a decline, which did follow the U.S. equity market as well. But you could see once it reached 2020, when the pandemic happened, you can see that it surged up 332%. So if these two stocks performed well under Trump, I wonder what freaking stock would perform well under Trump today, when there's certain trade wars that are going on that sound very oddly specific to what happened in Trump's first term, right? So it doesn't mean these things are going to go 1,000 or 300%, but it's stocks you have to keep an eye on, because things tend to repeat themselves. It's similarly. All right, now this is our previous bear markets thing. I got all the screenshots. We're going to dive into each one. We're going to talk about, what happened here and all that. So yeah, this is why I had to delay the call, because it took me a while to look at this. So 1987 Black Monday. You guys have obviously heard of this, especially the past few days, because everyone's scared this is going to happen on Monday. And I'm not going to say it's not going to happen, and I'm not going to say it is going to happen. But it's a probability. But here's one thing you have to realize. In 1987, they did not have circuit breakers. Circuit breakers are a crucial thing because it reduces the amount of drawdown that the stock market holds. So, for example, there's like stock markets, circuit breakers placed so that if, the ETFs or the futures markets reach like a certain drawdown, the stock market is going to be halted for a certain amount of time. And if it reach even like a drastic level, the market's just going to be closed for the entire day. You guys can search this up. You can search up, circuit breakers levels, and you'll figure out the exact levels right now. I think it's 7%. I think it's 13% and 20%. So 20% reaches all day. I'm pretty sure 7%, I think, halts the stock market for 15 minutes. And I believe 13 or 14%, whichever one it is, halts the market for like 2 hours. So even though there's, in 1987, there's no circuit breakers, but you will have that now with, our current market. Back then, they didn't have it. But does that mean that we're going to have complete safety? Absolutely not, right? But what it does is it gives people and, whatever, panic selling to kind of calm down. And you could see here, if I zoom in over here, you'll see Black Monday, what happened. This is SPX, so all of these charts are SPX. SPX lost 20% of its value in just one day. So you could see here there's nothing more to really see. But once we had this, the rally that happened afterwards was pretty decent. But this lasted very quick, right? This was not really a bear market, but this is something you need to pay attention to, because this was event driven. So remember, the reason why I talked about all these different types of bear markets is so you can try to figure out which kind of bear market we're in. Do you believe we're in a cyclical one, right? Because it's driven by a possible recession. Do you think we're in a structural one because there's tech, overvaluation of AI? Do you think it's event driven because, similar to a pandemic, we're having all the tariff wars? You think it's speculative because, there's just a bubble? I don't think we're personally in a bubble, but you could say we're in a bubble. Do you think it's secular, right? Do you think we're going to go to one of the worst type of bear markets you can go to, right? And do you think it's a correction? So you have to figure this out, and this is why we're going over the different types of charts so you could see the violence or the chaos and at the magnitude that it happens, so you can figure out when tomorrow comes what you're going to expect. So again, there's not too much to really see on here. You could see, one big reason, other else than the lack of short circuit breakers, was the fact that the market was on a massive rally during that time frame. And you have to realize 1987 obviously had less volatility compared to now. So this immense gain, which was, what was it? 128% in that short time span was a lot, right? Right now, if we had 128% gain in that time frame, it's nothing, right? It's just like, all right, it's normal. But for back then, it was very, very overbought, and it was very overvalued. So that's what even caused all of this. Because during this time, what happened was, because of all this hype of everything, right, all the new innovation, there's a lot more retail traders that were piling in during these points. And of course, there's dumb money along with small money, right? So, foreign central banks were piling in their money to the U.S. equity market, similar to now. And there was just a lot of false information given. And then before you know it, since everyone had so much buttload of money invested in the U.S. equity market, they start selling once once the crash started. So that's what happened in 1987. So 1966 to 1982 was stagflation. This is a secular bear market. Look at this chart. This is over the course of 12 years. For anyone that thinks this is okay, this is not okay. This means a lot of companies during this time, even if they're valid, can become companies that will no longer be valid afterwards. There was a lot of great companies during this time that no longer are great blue chip stocks. You can do this research, and it's crazy. Because of this secular bear market, because of this range, you don't get an influx of investment, which stunts growth, right? Because why are stocks on the stock market? To receive cash to invest more in their company. So if they're not even receiving, and there's less investors, and the big money is kind of just not in the market, tell me how this is a good market. It's not. This is one of the worst bear markets you could ever wish for. And even though it looks like, oh, I could just buy the bottom, buy the top, you have to realize that doesn't matter. Your current day trading or swing trading account is irrelevant. That's not what's going to save you in your future. Your long-term accounts are what's going to save you in your future. Your future matters more than your present. And if this is the bear market we're going to get, you could see some very valid companies that are very amazing, have great earnings, great revenue, great fundamentals that could completely be eradicated by this bear market. So this is not a great bear market. And I'm not saying we're there yet, but we have to really hope it does not reach this. Because again, secular bear markets last for decades, and it's caused by inflation and stagflation. You can say we are in inflation right now, right? Obviously, so we have a few signs, but again, you have a few signs for all these kind of bear markets. So we just have to hope it doesn't reach this, because remember, we already had a bear market in 2022. So is it a great thing that we're having a bear market now, and just 3 years later? Not so much. And no, it's not great money for the markets, for money markets and bonds. Money markets, I'm not sure, but bonds maybe. Yeah. Yeah, Randy, you're right. Wait, I think you're right. So 2000 dot-com bubble was a structural bear market. If we zoom into this, even though the dot-com bubble is pretty bad, this did not have as much economic effect as, for example, the 2007 crash, right? This was just more of people losing their money who were more invested into stocks in the U.S. equity market. And you could see, like, this is why I was saying in the beginning, bear markets are pretty bad, but it's not unbearable. This doesn't seem chaotic, right? It seems like, okay, yes, of course, there's chaotic days, like this, and these and that, right? But you could see, like, there is range in this, and that's why I said bear markets are not always just violence. It's trending towards the downside, and you're gonna have unfortunately setups invalidated, but it's a lot of range, right? Because this is a slow range to the downside. So this is what I would personally prefer if we were to have a what's it called? a bear market, well, we are in a bear market. So if I were to have any bear market, to be honest, I would prefer a structural bear market because I don't want the market to rebound and just reverse into the upside tomorrow and then reach all-time highs. That would be very unbeneficial to the health of the stock market. And that matters as much to you, even if you're a scalper, as much as it matters to a long-term investor, right? Because if we just reverse and go to all-time highs starting from tomorrow and the market just bottoms tomorrow, we're talking about an increase in overvalued companies and a much more influx of dumb investors, right? Because why did the 2022 crash happen? Other else than everything else that led to it, one of the biggest reasons was the amount of money that was taken from stimulus checks and put into the stock market. So that caused a lot of, because everyone just thought, oh, if I just buy the bottom, my stock is just going to go up and I could just retire off this. And yeah, people made money buying off that bottom. But a lot of the people who made money off of that lost all of the money they gained during that intense rally in 2022. So much rather have a structural bear market because it's much more, I would say, controlled and less detrimental to the economy. Of course, 2008 global financial crisis, this is obviously the one that almost everybody knows because it's one of the most recent bear markets that you could think of that has one of the most impactful, uh, you know, effects on the US economy. You can say the US economy technically died from 2008. There are so many companies, so many things that have just never recovered since 2008. And this was just one of the worst things that could ever happen to both the US economy and the US stock market. And we have never fully recovered from it. Even though the markets have reached all-time highs, we have still never fully recovered from the amount of debt and all the chaos that happened from 2008. You could see this was kind of like manageable at first, right? It was kind of slow. It was structured, right? But then it became chaotic, and this chaotic part is where a lot of retail traders ended up getting, unfortunately losing a lot of money. So when I keep on saying, it's not the first phase of the bear market, first phase of the bear market that's going to hurt you the most, is the second. This is a good example of what I mean by that. So this was a cyclical bear market when it came to 2008, right? Because it was caused by, I'll go back to cyclical definition over here. It was caused by economic cycles and it was driven by recession. So yeah. All right. What was the next one? 2018. So this was again under Trump. This is because of trade wars, especially, of course, China and everything. You could see the market. It was more of a correction than a bear market, but it's still worthy of looking at. You could see we lost value very quickly over the course of days, and it's pretty funny because we're seeing the same thing now. But it was very volatile, very sharp sell-offs. I think the market declined only 19% or something. So it's definitely a correction type of bear market when it came to 2018. But you could see the same kind of trends that happened in 2018 that are kind of happening now. So keep that in mind. 2020, obviously the second most, you could say, recent bear market, which was more of a flash crash. This was an event-based correction, not correction, bear market. Obviously, the pandemic hit. Everyone was scared that we were going to have closures, and we had all the, what was it called? Where everyone stayed at home. I can't even think of the word because my brain is fried right now.
Work from home.
Yeah, so because of that, that caused the sharp sell-offs, but we had a pretty sharp rebound off of that lockdown. Yeah. So yeah, that's what happened in 2020. And of course, 2022, which was cyclical, was due to inflation. This was all because of the stimulus checks that was pumped into the U.S. economy, whether people used it for just buying things like crazy, or whether it came to most of the people just put it into the stock market. That's what caused 2022. So you could see 2022 was not a completely bad bearish market. Out of all the examples we looked over, I would say even the dot-com bubble was pretty bad, and 2022 was pretty bad as well. I would say these two examples were manageable bear markets, and if we had something like this or like 2000, then it's okay, right? Not okay, but it's a little bit more manageable. But if we get other type of scenarios such as you know, like the not really 2020, but 2008, 1966, 1987, 2018 kind of, we're going to find yourself in a lot more pain because there's less reaction time, a lot more emotions involved because the volatility is just very, very high during these times. So you could see here, one thing I want to point out on these charts is you can have massive, like, this is what I want to talk about. This is why I said it's irrelevant of what the futures are doing today, because you can literally have the futures, be all the way down, and then the next day stock market opens up, whoops, and the stock market goes down, and then it just rebounds like crazy. So if you're a long-term investor, what's the point of looking at the futures market right now, right? Why have increased panic? Remember, if you're a long-term investor, you're trying to look for the long run. You're not looking for just a few months out. You're looking for years out. So maybe these kind of movements don't really matter to you. So just remember, look at this. You have one example right here and one example right here of where you get these sharp drop-offs, but you get huge short squeezes to the upside. So when you get extensive sell-offs, expect eventually something to happen like this. Does that mean you go buy calls like an idiot? Absolutely not. That's not what I'm saying, right? If I was saying that, then I would have bought, Meta calls on Friday, but I didn't, right? Even though Avgo looked great, I didn't buy Avgo calls. I only bought Baidu calls because if you had to go look at Chinese stocks like Baba and Baidu, they've been holding up decent compared to the U.S. Equity stocks. So, Baidu had a great setup on the 30-minute, so I couldn't resist myself from taking a Chinese stock setup, so I took calls on it, right? But I also took PG puts because PG looked bearish. So you have to be smart about what you do. You can't just over leverage and stuff like that. And you can't just think, oh, because the markets are down, it's just going to keep selling off. And you can't just think, oh, because the markets are down, it's just going to shoot up. You have to just let the dust settle, and you have to react instead of act and try to front run things. Don't front run things. You're not smarter than, the market, right? You could probably be smarter than me. I'm not going to say you're not, but why not let the market show its hand and then you react to that? There's literally no reason why you have to panic and rush in a bear market, because I'm telling you, your opportunities come in a bull market, not in a bear market. So please realize that your opportunities will come in the bull market, not now, and it's okay to sit out on certain days. It's okay to sit out for weeks. It doesn't matter. It's just okay, just sit out sometimes and know when you just want to let the market show what it's trying to show, and then you react to that. So you could, I just wanted to point this out. You could see sharp sell-offs, right? Sharp sell-off. Sure, yeah. Let's do a sharp sell-off, sharp sell-off. So I wanted to show that because you want to look at more of the 2022 and the 20. I guess you want to look at 2018, 2020, and 2022 more often than the other bear markets, because this is obviously more modern, so you can see how volatility has been acting. And you can see volatility has increased as the years have gone by. So these three sets of bear markets are what you want to go back. And let's say you trade NVIDIA a lot, go back to these years and see how NVIDIA acted. If you trade Apple a lot, go back to these years, see how Apple acted, right? You could do all this by yourself. It's so easy to do this. So please definitely do that. IV plays a big role. There's a difference between IV expansion, IV contraction. This is pretty straightforward. When you have sell-offs, as I said before, you're going to see IV increasing, but everything always reverts back to its mean, which means if you have extended sell-offs, the IV is going to be increasing as it keeps on, keeps on selling off. But that doesn't just mean you keep on buying puts over and over and over again, right? When you reach, continued sell-offs, maybe it's just not even worth taking puts anymore. During this time over here, right, I remember this specific day, a lot of people bought puts on this candle and this candle right here. People who bought puts on this candle over here were somewhat right. And in the morning, it ended up not gapping up, but it ended up coming down and then going back up And because of them going back up, because of the stocks going back up, their puts that they got on the previous day got completely eradicated because they bought it at a high IV area, right? Because all the puts were so massively expensive, and eventually these puts have to expire worthless, right? So the theta is high, the IV is pretty high, so it needs to reduce when the movements are, going onto the bullish side or IV's decreasing. So a lot of people lost money on this day on puts, right? On this day right here on puts, because they got shaken out by this freaking wick that happened right on the daily candle on the top. Even though the ETFs and the stocks ended up going down later on the day, people who bought puts on this day got even more hurt by this day because in the beginning there was a shoot up and which killed so many option premiums and then eventually melted down. But as you saw, just the freaking it just rallied after that, right? Same thing for here. You could see what I mean. So these areas, right, where you see this is called an IV contraction, which means if when you get a sell off, you get IV expansion because IV is increasing, right? IV is increasing. But when you have bullish movements, especially a movement like this, or you're stuck in a range, your IV is going to decrease. So if the IV is increasing over here, right, and let's say a stock usually is around 50% IV, right, or their IV is just 50%, and then during the sell-off, the IV increases for the option chain to 100%, it's not going to stay at 100% forever. It's going to eventually revert back to 50%. So because of this IV decrease or this IV contraction, you're going to have those option contracts reverting back to close to 50% IV, and then you're going to find yourself, even if you're in calls, you're going to find yourself in a world of pain because you bought it at an early point when the IV was so high. Because remember, implied volatility on options increases and decreases your option value. So just because a put setup looks great, if the IV is very high, you have to ask yourself, is this really a smart time to buy contracts? A great metric to look at to see if the IV is high, right? Because you have a stock like Coca-Cola, which has less IV than a stock like Tesla. I've talked about this in previous videos. The statistic you want to look at is current IV percentile. I'm going to break it down very quickly because I've talked about this numerous times. If the current IV percentile, for example, is at 80%, right? It says IV percentile. Oh my gosh, I can't even write. Just pretend that says percentile. Let's say it's at 80%. This means that in the past 52 weeks, the current IV on all the on all the expirations for that option chain for that stock. So let's say for the stock Tesla, right? 80% of the 80% of the 52 days. Oh my gosh, 80% of the days in the 52 weeks had a lower IV than the current IV. Now, let me give you another example. If it's 20%, or let's say not even 20%, let's say 40%, that means the IV in that specific day is only higher than 40% of the days in the 52 weeks that the data is recording, right? So the higher the number, right? The higher the number. If you let me dumb it down, right? If you can't understand, the higher the current IV percentile, you have to think of it like, hey, I'm paying a very expensive amount for this option contract. A very low current IV percentile means you're paying a cheaper price for this contract. So how can you use this? When your current IV percentile is up, this means it's a better environment to sell options. Now, what I mean sell options is not really like, I guess it could also mean just like closing your positions, but it also means entering into credit spreads, entering into iron condors, right? Iron condors, if timed perfectly in a bear market, are some of the most profitable trades you can ever do. I personally opened iron condors on Friday because the current IV percentile for SPY, you could go look at this, for SPY, QQQ, IWM, and DIA were all at 100%, which means it was the highest IV that's been recorded in the past 52 weeks. So if Monday or even Tuesday we have just a rally or a range, the IV is going to shoot down like crazy because obviously IV measures what the implied move is going to be, right? Or what the market expects if the market's not really moving, why would the IV be high? The IV is going to reduce. So if you have a bull run or if you have a range, the IV is going to shoot down like crazy. And we've talked about how when you sell credit spreads, right? Because you sell to enter credit spreads and iron condors. When you sell credit spreads and when you sell iron condors, they benefit off of contracts decaying off of theta, right? And IV crushes. So this is why when it's above, like, let's say 60%, right? This is what I personally look at. These are just my personal observation and opinions. When a stock is above 60% current IV percentile, I tend to be very cautious when I buy options. I personally don't like buying options on a stock when it's above 70%. That's just like a no-go for me. I'm Indian, so I'm pretty I'm pretty a stickler for what I pay for. I'm not going to pay for an overvalued contract even if my even if my sentiment is correct. For example, my Baidu call that I got on Friday, the current IV percentile unfortunately for Baidu was 80%. So that means on Monday, even if the Baidu goes up and is bullish, that contract is still going to lose some value because I paid at a very expensive point. So what does that mean? So if it's below 60%, that means the options are relatively cheap compared to the past 52 weeks. So below 60%, again, these are all my opinions. Below 60%, this is when I consider it's a great time to buy options. But above 60% is like, okay, all right, maybe it's too expensive to buy options and I'm just adding on risk, right? So keep that in mind. So that's how you gauge if the options IVs are very high or very low. Because again, you can't just look at IV and be like, oh, this is very high. Because even though that does matter, you have stocks like Celsius, MSTR, Tesla, which are naturally higher IV contract option chains versus stocks such as Coca-Cola, Pepsi, Kroger's, Walmart, which have statistically lower IVs. So you have to know where exactly the IV ranges within that stock's IV percentile. If you just want to get a whole typical idea of where the stock market's IV is, you could look at the VIX. VIX is great. You can look at the VIX options current IV percentile, or you could look at the S&P 500 or SPY, right? So that's a great indication. So again, I explained what IV expansion is and IV contraction. Just because something's selling off doesn't mean it'll continue selling off. You will eventually need a revert back to the mean, and the revert back to the mean, which we were talking about before, is current IV percentile. Just because something's at 100%, eventually you might see it go back from 100% to 80% to 70%, back to 50, and then back up to 80%, back down to 20, right? So there's a constant IV expansion and a constant IV contraction. So these both have very important effects on what you need to be looking at. Know how to hedge. This is very important for swing trades and also for long-term accounts. You need to know when to sell covered calls and you need to know when to buy puts. This is especially for long-term accounts. If you have a lot of shares and you have a long-term account, you don't just keep on selling covered calls just because you want to sell covered calls. You'd rather want to sell it when the IV is high. And again, how do we figure out when the IV is high? When the current IV percentile is high. Know when to buy puts. The best time to buy puts is not when the stock is actually sinking sometimes. The best time to buy puts is... Where's my charts? Oh, yeah. The best time to buy puts is when the stock market increases, right? Or ascends, right? When it goes bullish, and let's say you had a level here on S&P 500, you know what level I'm talking about. That was a terrible drawing. But let's say you had a level there, and you see like one bearish day, right? Obviously, because of this bullish movement, let's say if the current IV percentile was even, let's say it was 100%, right? Because of this bullish movement, the current IV percentile would be probably around 60% or even lower, right? It can be a lot lower. And at this point, let's say you wait for, why are these brushes so big when I'm trying to draw? I think I have ADHD at this point. So let's say the IV increases at this, right? At this rate, and then increases here and then decreases on this rate, right? IV decreases in this rate. You're going to be buying at a low IV percentile. And let's say you wait for even 2 or 3 bearish days to happen. You're like, okay, all right, I need to protect my my stocks, my shares. That's when you buy puts. That's when you buy puts. When the current IV percentile is low, that's when you can buy puts, because then you can hold it and you can even trim out early, because as the stock market declines, the IV increases. And what happens when the IV increases? Your options increase. You gain from that. And yes, of course, there are some bounces here and there, but if you're hedging on a portfolio, you're not idiotic to buy short-term puts. You're buying long-term puts, right? So yes, if you were to buy, please guys, if you could stop tagging me and putting messages in the live chat, that'll help not distract me. But if you buy long-term puts, you can do very well on them, right? You just had to buy it at the right time. That's what it is. People think they could just buy puts at any given time and be fine. No, you can't just be fine from buying puts at any given time. You need to buy puts when it's the correct time. Um, so was Friday a good time to buy puts for your portfolio? Yeah, in hindsight, if we get like a black, let's say if the stock market crashes down 8% on Monday, well, tomorrow, yeah, in hindsight, you could think, yeah, of course, we could have, if I bought puts, I would have been right. But how many times has that actually proceeded to be the case? If you look back and see, the how many times has that repeated back in history when you've had overextended sell-offs? Because remember, our current, if you go look at S&P 500, and I'll bring up the chart right now on my screen. So let me show you. Compare all the bearish charts we had to this. Look at these massive gaps. These are gaps. These are not massive red candles except this one. These are massive gaps. So if you see gaps, that is extended sell-offs. Again, does this mean things are going to just skyrocket the next day? No. But where the heck did my thing go? But that means that's just something you want to keep an eye on. Let me connect my screen back again. Sorry. I'm using my amazing S9 Ultra Samsung tablet, which is better than my iPad. But what was I talking about? Yeah, so you want to look at, okay, is my is when is it right time to buy puts? Well, okay, is it once the bull market, not the bull market, or the bullish movement happens, or once the IV decreases, the IV percentile decreases, because then you're buying it at a theoretical safe point for buying options. That's how you figure out when to buy options. And then when do you want to sell covered calls? Well, when the IV percentile is high, because then the second the IV percentile decreases, you're going to see a lot of profits gained from the premium decay. From that, yeah. All right. Let's see what else. So sizing is a huge thing. Sizing is just huge. If you could get a grip on sizing, everything else that we talked about here is going to be easy to come by, in my personal opinion. Because if you sustain losses, those losses are going to be very minimal. And I said multiple times, remember, your goal is to survive, not thrive, especially in a bear market. Once the bear market is over, then you could be like, okay, all right, it's a bull market. Now I want to thrive. Now you can be aggressive. Now you could take on risk. And I'm not talking about dumb risk, but you could take on risk and you could potentially size up from your smaller position to your normal position. That's when you could see your account grow. Please, guys, I've been here for 12 years trading, and I've been on Discord here for 8 years. So when I'm telling you that you can't just be looking at just a day-to-day basis, you need to be looking at, where am I going to be 2 years from now? Because if you're not even asking 2 years from now, 5 years from now, 10 years from now, your success that you even were to gain right now can potentially be evaporated 2 years down the line, and then plus more. So you find yourself not only losing all the hard work that you had, but finding yourself in debt. And I don't know how many people have been through this scenario. So that's pretty much it when it comes to this presentation. I hope you at least, this is the main thing. Just remember this. I mean, everything else you can figure out by yourself. You can disagree with me and all that, but I hope you don't disagree with this, because this is something you need to pay attention to. And even if that means not following my trade ideas, just that's fine, dude. Just go take care of yourself. I'll be completely blunt with you. You know, I might know your name, but am I gonna take care of your account? No, that's all up to you, right? So I care, but only to a minimum amount because I had to care for my account before I care for yours. So care for your account, do what's right for you, and doing what's right for you is not being idiotic. So be very patient, be very smart. There's so much more we could talk about bearish markets, but I thought this was very crucial, especially when people were just panicking like crazy on Friday and Thursday, when people shouldn't have been panicking because, yes, even though we were massively down on every major index, I was not down. Why was I? Well, I was down on Thursday, but I was not massively down. And yes, you could chalk it up to my superior, trading as in my trading skills and my experience and everything like that. But it's also because I implied what I talked about. I did not size heavily. Even in my day trades, I didn't. On Thursday, you think I sized heavy in my day trades? Absolutely not. Even though my account was down -2%, I didn't size heavy on my day trades. I sized light. I sized light and I just traded like I usually do. And you know what? It ended up that my account being green, right? My day trade account ended up positive 4%. Because I have separate accounts for separate things, but I have one account that has like all my swings and my day trades. That account went from being -2% to just being -0.08. I think it was something like that. So I didn't trade that day because I wanted to make back my losses. Absolutely not. I just realized there were some great setups that I could trade, and I traded it, and I traded very small amounts, and all I needed was I think like 3 trades we had that day, and it was great. We had Snow puts, Microsoft calls, Home Depot calls. What was that Friday? I don't remember, but one of those days. So take me as an example for a person who can still do well by taking on risk, but not taking on dumb risk. Taking on dumb risk is when you're already taking risk and then you're adding even more risk just because you want to be a retard and you want to size more, right? Excuse my language. But yeah, that's all I had to say about this. There's a lot of things you guys said, so I can't. I'm not going to scroll all the way up. But if you guys have questions that I didn't go over, please ask them in the live session chat, and I'll definitely go over them and answer them to the best of my ability. But yeah, thank you again for what's it called? For listening. Why can't I move my mouse?
Is the session over?
No, it's not. So please don't speak.
Oh, sorry.
No worries, man. This is not going to be a talking session, so you guys just feel free to message in the live session chat, and I'll get to them. I again do not mind at all whatsoever to answer your questions. I don't know why my screen is frozen, so I'll just disconnect my. I'll just bring up my charts right now, and we'll just close my tablet stream. All right, there we go. Why isn't this closing? So you guys should have a lot of questions because there's a lot of things I didn't go over. So again, I'll get to the stuff that I read, and yeah, give me one second. Let me bring up my charts. All right. Okay. I'll scroll up just a little bit. I'll answer some questions I didn't answer, and then we'll go through this. All right. If the market opens down tomorrow, the VIX is almost likely to rise a lot. Yes, that's true. I see VIX never stay at above 40 for more than a week. Would shorten the VIX be a viable strategy? VIX options are one of the most profitable option chains you can trade if traded correctly. The reason is because you can get very volatile movements, but that could also work against you, right? For example, I actually bought VIX calls. So VIX calls are a very great way to hedge your portfolio if you believe that volatility is going to happen or increase. So if you guys remember, this is where we had that trend line, by the way. We draw it somewhere here, and ever since then, VIX has just been increasing. But for my long-term portfolio, for example, on Thursday, I bought VIX calls because the VIX was just looking like it's going to squeeze more. It did not seem like the bearish sentiment was going to end. And of course, I didn't buy them on Wednesday because why did I buy calls on Wednesday for the swings I took? Because everything was looking bullish at that point. No one really expected, Trump to come out for a tariff that's going to hit even bigger than what we expected, right? So we got VIX calls. The VIX calls were a great hedge. We saw VIX go from 29 all the way up to 45. The calls were just massively profitable. But then what about the dumps, right? Because VIX has massive dumps to the downside, right? Because it's volatility contraction, right? Whenever you see VIX goes up, think of it as volatility expansion. Whenever you see VIX go down, that's volatility contraction. So you can see here, even though there's volatile movements on the VIX to the upside, there's very volatile movements to the downside as well. So how do you go to basically buying VIX calls to short the VIX? So to buy VIX calls, buy VIX puts here, you have to, no matter what, you have to size light, whether it's a hedge or whether it's a swing trade. You can't just go in, just buying a VIX put and thinking, hey, I'm going to be fine. Because you're probably going to be in a drawdown for 2 days before it goes green. The next thing you want to look at is the current IV percentile for the contracts. You want to make sure the IV, that the option chain for the VIX is not at a high current IV percentile, because even if you get your move, again, your move might not come the next day. It might take 2 days. Your contract's just going to decay like crazy, and then when your move comes, your option might be just like right at break even, or most of the times, in most cases, at a drawdown. So if you're going to short the VIX, definitely be very careful, which usually just means sizing very light. There are levels to VIX, and JP has a video on our YouTube that goes over the VIX and the levels he has on the VIX. So make sure to watch that, because when it hits these levels, it doesn't mean it's going to reject, but it means like, hey, if it breaks above this, then we're going to go even further. If it breaks below this, we're going to reject like crazy, right? So you can use that to your advantage. VIX follows levels very, very great. So watch that video. Again, you don't need to be looking at US futures right now, or any futures, because you guys probably see it. I didn't even look at futures today. I'm telling you, from market open, I've not looked at futures. I bet you exactly what I said on Friday is happening, well, on Saturday is happening right now, which is I said that I bet the markets are going to gap down, which unfortunately I do know, because there was all the Twitter posts everywhere and I had to open up the Twitter stream. But I bet well, I'm all halal, bro, so I'm gonna take back that bet. But I have an opinion that the market is actually, futures markets are rebounding. And you guys can confirm me if I'm right. But if I'm right, that comes to show you how IV contraction and IV expansion works, right? We were just at a very oversold thing, and just because we gap down does not mean we're going to keep on going down, and it also does not mean we're going to keep on going up. But that's why it's just not even important to look at the futures market right now, because there's still the Japan session, right? The Asia session that needs to open. We don't even know what's going to happen there. I think the London session already opened, right? I don't really remember the times and everything like that. And then you have the New York Stock Exchange. You have the American, yeah, like 2 p.m., right? 2 a.m. Eastern, when that opens. So there's a lot of things that will happen before tomorrow's open. So what's the point of looking right now? There's just no point. Why panic, right? No need to panic whenever we're already going in bed and crying and panicking already, right? So yeah. A lot of people forgot the original purpose of options. Oh, let me show my screen here so you guys can see what I'm looking at. So a lot of people forgot the options are. Wow, a lot of people forgot the original purpose of options were insurance premiums for. Yes, thank you, Randy. That is the exact reasons why options are a thing. And of course, they were made for hedges, right? Options were for hedges. That's why VIX is a great hedge. That's why puts are a great hedge. When people in shorts, they bought calls. So remember, if you have a long-term account, options are a way to hedge. You just have to buy time, and you have to buy it at the right time. And you don't need to buy at the right time is not necessarily meaning you have to buy it at the right level, right top or whatever. No, you just need to buy it when the IV is low. You need to size appropriately, because your hedge should never be anywhere close to your actual long-term position size. It should be a very small amount, and it should just recoup some of the losses. If you buy a put, that put should recoup some of the losses that you get in the down run, because you expect that stock to go up in the long run, right? So you want to just give your stocks a little performance. If you're just a buy and hold kind of investor, don't even bother, right? In my opinion, just don't even bother, because if you're just buying and you don't care what happens in the next 2 years and you're only looking 10 years down the line, why even try to bother risking your capital to buy and hedge? You're just looking 10 years down the line. Just make sure you buy good companies. That's all it is. Unless we get into a secular bear market, then you got to reevaluate your positions there. How to determine when? Okay, I answered that question. Okay, when you say sizing, you would go less risk on a bear market. Yes, absolutely. So in a bear market, I am going to be sizing way less compared to a bull market. Um, what's a? I'm just gonna give a day trading example, and you guys can make this with what you want. Let's say my normal size positioning is 10 contracts, right? Or let's say it's $1,000. Um, in a regular bull market, I never just go full ho, gung ho, and just size my normal size. I usually go halfway. So instead of 1,000, I go 500. And if need be, if I really need to, if I need to average down, then I add in whatever, if it's 200 more, 300 more, and then the max I do is $1,000. That's how I would size in a bull market, right? Because bull markets are a risk on type of environment. But what do you do in a bear market? Bear market is risk off, which means anything you see is going to be risky because the probability of working out is pretty low. So instead of sizing $500, I'm maybe sizing 100 or 200. And hey, if my trade works out, it could work out pretty well. I don't need to have a big size for it to work out, you know, pretty decently. Remember, bull markets are just long-lasting bull runs. That doesn't mean the bull moves each day are pretty huge. The fun fact, the biggest bull moves were actually recorded during bear markets. So an intraday bullish move are the biggest during bear markets. Why? Because of IV contraction and IV expansion. So because of that, you have some of the biggest bullish days on during bear markets. That's why dollar cost averaging is such a huge thing and so highly advocated for. This is a perfect technical market to start dollar cost averaging. If you got a Roth IRA and one thing I'll say Robinhood does good is the DCA, the dollar cost averaging thing. You could just every day you can invest like $1, $5 every week, just invest $50 here into your favorite stocks. You just buy here and there, it doesn't matter, it just buys randomly or whatever day you want it to buy on. And then, one day you might get it on a red day, one day you might feel on a red day, and the next day you might feel on a green day. And out of those 3 days, because of your dollar cost averaging, once you look a year down the line or even 15 years down the line, you're up massively because of those dollar cost averaging. So remember, in a bear market, you size less because if you, for example, were to take calls on a call setup and you size less and that call setup ended up running. Look at the call setups we took on Friday and Saturday. Not Friday and Saturday, geez. Friday and Thursday. Our Home Depot and Microsoft calls went for a decent amount, right? Because the movements that happen, if you get the call setups, right, the correct call setups, the moves last for a while, for not really for a while, but they're pretty violent to the upside. So remember, the biggest bull run moves happen during bearish markets. Compared to bull markets, we just have longer, steady, stable bull moves. So remember that. So yes, I size lighter on bear markets compared to bull markets. And I gave an example. I don't know what more you can ask, right? $1,000 is, let's say, my cap for what I would just risk in a trade. And in a bull market, my initial entry would be $500. My average down would maybe be 200 or 300, and then I would cap it at 1,000 in total. And then in a bear market, instead of starting my initial position at 500, I may be looking at 200 or 100. Everyone's risk management is different, so you can figure out what you want to do. So you're saying you're willing to risk 2% per con for bull, but then you'd risk 1% for con per bear. Per con, I think you're talking about per portfolio, because I think you're taking from what I said in the risk management thing. Again, that's completely up to you. You got to figure that. But if you were talking about ratio right there, right, since it's half of the risk, yes. If you're talking about half of the risk, then yes. Yeah, absolutely. You're welcome. What's your thought on LI autos? I'm not gonna get to tickers just yet, charts just yet. You mentioned in your option low beta is the way to go in this bear market. Absolutely. Do you think that will also be the case when the market is bullish, or does high beta become easier, or is everything fair game? This is a really great question. Thank you. So in bear markets, low beta is always going to perform, especially safe havens. So you're going to see SLV, TLT, Coca-Cola, Pepsi, Waste Management, PEG, Kroger's, Walmart, Costco, TJ Maxx. I'm just spilling a whole bunch of safe havens here, so I hope you guys are listening. What else? Um, I got a whole list for you guys. KMB, Kroger's, FTS, GIS, PSA, EXR, Cube, NSA, Colgate, MDLZ, NEE, KHC, Johnson Johnson, MRK, AMGN, CLX, VZ, BJ's. BJ's are great. AT&T, BTI, FE, well, not FEZ. So actually remove FEZ and remove VGK. eBay, DG, HSY, BABA, KWEB, Baidu, uh, BLI, PDD, right? And some other ones are, if you guys follow me on Twitter, I posted the utilities watch list, another important sector you should look at. CNP, CMS, AEP, AWK, CWEN, FTS, NWN, PPL, SR, UTL, AVA, NWE, NGG, EXC, ED. It's crazy that I'm saying all this all without stuttering. AGRO, AKOB, CCU, NGR, KOF, NOMD, WMK, ACI, BTI, CCEP, CL, DG, HRL, KDP, KMB, Kroger's, PRMB, SJM, TAP, TSN, UL, Coca-Cola, PG, and PM, and of course MO. Why are these stocks important to keep an eye on? Well, these are considered safe havens. So what that means is, even if the stock market is down 40% of the year, and by the way, those stock lists, those watches I just gave you are what usually people charge for. So I hope you guys, either once this recording is done, you look back at them, or if you follow me on Twitter, you guys already have the watch list which I posted. So I hope you guys paid attention to that part. But the reason why these are great stocks to look at, not all of them are going to perform the greatest, so you have to figure out which perform great. You could see that based on, the drawdowns, how much it was down per day, right? But the reason why these safe havens are great to trade during a bear market is because they have lower drawdowns. So the stock market, for example, can be down. A great example is SPX, right? How much was SPX down? Well, forget SPX. Let me just go to, oh my God, I'm hiccuping. Let's go to SPY. I'm talking a lot here. Let's go to SPY. You could see why I say I might have ADHD. Let's go to SPY. We see Friday. SPY dropped down. I don't even know why I drew that when I could freaking see on the bottom. The SPY was down -5%, but you could see here, look at some of these safe havens, right? You have -2%, -1%, -4%, and please don't speak while during this live session. Refer to only talking on the main chat. You could see these drawdowns were a lot less compared to the stocks that were in the risk on, right? The risky assets, right? So Qualcomm, Adobe, Avgo, Tesla, Nvidia, these all were down 5%, 8%. But if you go to the safe havens, of course, some of them were down, right? A decent amount, but a lot of these were down below 4%. So the funny fact was, on Thursday, a lot of these stocks were green. In fact, the watch list, which had to do with the utilities, were all green except one stock, and that one stock was green. That was green would have been green by end of day. It was like only down to 0.10%. So because these are performing so well compared to the high beta stocks, that means the setups are way more valid on these safe havens, which means you can trade your options, not risk on. You're not going back to your normal sizing in a bull market, but you could be a little bit more confident about the setups you take, right? Because there's a lot more likelihood you're going to be seeing those setups work out. Why is that also an additional factor? It's because you're going to see. Let me just make sure I have everyone muted here because I'm getting distracted by whoever's unmuted. You're going to see that, though, like, dumb money is not going to be in that. Dumb money is going to be in stocks like Nvidia, Qualcomm, MU. Everyone's going to be in these stocks, Everyone's going to be in these stocks, but barely people are going to be in these stocks. What's going to be here? It's going to be big money. It's going to be smart money, right? So these are going to be way less risky in terms of following setups. So during a bear market, safe havens are a lot better for options and in terms of trading them. And when it comes to a bull market, to answer your question, it doesn't mean you divert away from safe havens because they're still very stable. It's just if you want to grow at a faster rate, then the setup you see on the risky stocks such as Nvidia, Tesla, and Avgo, Meta, whatever it is, they have increased probability of working compared to a bear market. So you can technically risk that, right? So if you want to have stable growth, then you're going to just be looking at during a bear market and a bull market, you're just going to be looking at safe havens. But if you want aggressive growth, then what you would probably be looking at during a bear market is safe havens, and during a bull market, you're going to be looking at high beta. So hopefully that answers your question. So this is more up to you, what your risk and your objective is. But yeah. In your How I Trade post, you mentioned occasionally trading futures. Do you have any time frame or suggest recommend? That's not related to this, so I'm gonna skip that for now. Let's see. If the market opens down tomorrow and the VIX is okay, I answered that. Survive, not thrive. Love it, bro. Yeah, I should probably change my I should probably change it from this cringy thing where I say I don't read the market's mind. It's too busy to read mine. uh, Actually, I like that. I'll keep that. One question: how do you choose which stocks you trade with so many options? Very easy. On a very red day, this is the easiest thing you can do. On a very red day, you go through your big watch list. Again, you have my watch list, you have JP's watch list, you have my watch list from Twitter. If you guys are new to our Discord here on live sessions, you go to the links thing and you'll find the links of our full watch list and then our most traded watch list. And you'll find my safe havens one. And if you go to Twitter, you'll find my utilities and the consumer defensive watch list. Very easy. On red days, you go through the watch list and you just see, okay, you compare your watch list to stocks like Nvidia, Meta, Netflix, all the high beta stuff, right? So if SPY, Nvidia, all these things are down like 4%, 5%, you want to go through your watch list and be like, okay, what's only down 2% or 1%? That are the stocks you want to pay attention to because those are going to be your most likely your safer setups, right? And then when you get that list, right, when you weed it down to the stocks that are not performing as bad, then you want to just weed out what were just performing well because of good news. Just because there's good news doesn't mean that stock will perform good in during a bear market. That could just be a rally, for that time. A really great example is Nike and Lululemon, right? These are great stocks, but they're still high beta. Only reason why it was green was because of the whole the news about the negotiation of tariffs with JP, help me out. What country was it?
Vietnam and Cambodia.
There you go. Thank you. So because of that, thank you so much. Nike and Lululemon benefited off of them very well, and that's why, since these are apparel clothing stores, apparel, these benefited very well, right? So you have to realize that doesn't mean that does not mean Nike and Lululemon are freaking safe havens. That does not mean that whatsoever. Not by any means. So you have to make sure once you get that list, you have to figure out what exactly is a safe haven. MSTR was up 4%. Why was MSTR up 4%? Well, MSTR fluctuates with Bitcoin pricing. Only reason, realize this, people were so surprised at the sell-off today at Bitcoin. I am so sorry if you were. That is a very dumb reason to be. You shouldn't be surprised at that. The only reason Bitcoin was up, because everyone just realized that tariffs were not impacted when it comes to Bitcoin. So everyone just flooded, not everyone, but a lot of people flooded their money into Bitcoin, which is why crypto and Bitcoin did really well and performed really well on Friday. Does that mean I'm going to say right out that Bitcoin's not going to perform well in this bearish market? I'll be completely honest, I don't know, right? Bitcoin has only been here for a short amount of time. So am I going to really be heavily paying attention to it? No, because I know stuff that works, so I'm not really going to be paying attention to it. But that's why MSTR is up. MSTR is not a safe haven, right? Because it's a very volatile stock. So just because the stock is up or performing well compared to your watch list doesn't mean that's a safe haven, that's what you want to trade. But that's how you just kind of reduce the amount of stocks you're looking at. But yeah, let me move on. All right. Let's see. Hopefully, I answered your question. Not really related to this call, but any attractive setups? We'll talk about that later if I'm not dead tired. I asked about selling put for juicy premium yesterday. Looks like tomorrow will be another down day. Do you see this strategy as a dollar cost averaging for long term? Okay, this is a really good question, and I'll give you a really good answer. Dollar cost averaging is for people who either have very small. I first of all, everyone, if you're here and you're trading, you can afford a long-term account. It does not matter if you put $25 each week into the stock market versus $5, even $1. You're putting money into it, and that money you put into it is going to be set aside, and you can't touch it. And years down the line, that money that you put in, if you put into smart, good companies, it's going to outpace inflation, right? That's the whole purpose of investing. It's to buy undervalued assets, sell it when it's overvalued, and to beat inflation. So there's no reason, not one of you guys have any reason you could come up to me and tell me you don't have a long-term account. If you don't, I'm so sorry to say this, shame on you. You have Robinhood. You could literally, I think the minimum you can have to put into each order is like $1.25. You're telling me you can't even put $1.25 each week? Come on, right? So dollar cost averaging is great for if you're an investor who doesn't have a lot of money to work with, right? Because if you have money to work with, then you could look at strategies such as the wheel strategy, or you could just slowly, incrementally buy into your positions. But dollar cost averaging is great for people who don't have that much money to work with, or who are not concerned about looking at the market every single day. So a great example is maybe somebody who is in their 30s. Let's say if they have a high-paying job, or they have a decent job, or they're just throughout the day they're very stressed with work. They have work. They don't have time to look at the market and be stressing out with the market as well. There you go. Dollar cost average, the least, managing strategy you can put out there, right? And so it's for those who are young or those who don't want to be involved in the market every single day. You just set those limits, one day, and then that's it, one day of the week. Or people who can't afford long-term accounts. Hey, I hear you. Not everyone can afford $5,000, $10,000, or 200K long-term accounts. I completely understand that. But no one on here can afford even a $50 or $200 weekly input into the stock market. Because again, long-terms are something not that you look down, just a few months down the line. It's something you're setting yourself up for years down the line. So again, look at safe havens and maybe you want a dollar cost average in that. But when do you use the wheel strategy, which is one of my favorite strategies? That's when you have capital and you don't mind taking a risk. And you only do it on companies that are good. For example, a good example is Apple, right? Apple, I've always thought it's overvalued ever since it reached this point over here. And clearly so did Warren Buffett. But is this stock going to go anywhere down lower than, 100? Maybe, but is it going to go to zero? Absolutely not. So since the option premiums are so juiced on this, selling puts on these stocks are absolutely amazing, because we talked about this, right? I expect a IV contraction within the next week, right? So next week we're going to eventually, let me rephrase that. I think we're eventually going to have a bull day. So that means even if the stock market opens down 5%, and let's say I sold a 170, let's just say 180 put on Apple, right? And Apple opens up on Monday, it gaps down below, let's say the expiration is next week. So what's next week? 411, right? That's the expiration. So let's say I sold 411 puts for the $80, 180 strike. Yeah, Apple can absolutely come down to below 180 for 2 days straight. That's fine, because the whole reason you're selling puts is because you're absolutely fine holding on to the shares. But then one day, you can see Apple just squeeze up because IV contraction happened, or it ranges, and because of this range, right, it doesn't even need to get above your strike price. You can actually see the option premium decay so much that you can actually get out for a profit, even if it's still if the price is still below your strike. So when you sell wheel strategy is when you can afford to, and is when you really love the companies that you really want to get into, right? Um, the wheel strategy is basically a very expensive way for people who have bigger long-term portfolios to dollar cost average versus dollar costing average. Don't take this personally, but it's for brokies to get involved in the stock market and to build themselves a very strong portfolio in the future. So that's the difference. Good question. Yeah, JP did. JP has been phenomenal, man. This guy has been on VC, not VC, freaking live sessions the past 4 days with you guys. Plus to him, he's been on hours on end talking to you guys about topics you want. So props to him. So he did go over VIX levels yesterday. Not going over stocks right now. You're right. On futures market is going up right now. Yeah. What did I say? I swear to you, I did not even look at the futures market ever since I just posted the Twitter link for this live stream. That's the last time I just saw that, like, it showed, like, I think it was like 5% down or something. And look at that. Futures going up. Doesn't mean it's going to be up tomorrow, but I just knew it's going to eventually just have these squeezes to the upside, which, as you said, is due to volatility expansion and contraction 100%. Yep, absolutely. By the way, JP was so kind enough that oh my God, that's a lot of levels. But JP posted his video also on VIX. You could watch that. And he was kind enough to post this VIX chart so you could see the levels on here. If you guys are watching this on YouTube, once it's recorded, you could feel free to pause it and, take a screenshot of this and apply it to your chart. If you guys are on here as well, if you want to take a screenshot, I'll give you 2 seconds. This recording will hopefully be posted by tomorrow morning. But yeah. All right, moving on. I have NVIDIA as a long-term investment. Which levels would be considered to average down? I'm not gonna get too deep into this because I don't want to get too much into stocks right now. By the way, if you guys are long-term investors or you have a long-term account, 2 very important moving averages I think you should have, in my opinion, is the 200 and the 50, right? The 50 moving average kind of shows you the short-term sentiment of the stock. So that's something important to have. And you could see here, if you go to the daily, you can see that, let me delete this. By the way, it was crazy. Even before the bearish market video, we talked exactly what's going to happen to NVIDIA. You want to know when? I'll tell you when. And everything is timestamped. You could go watch every single of these videos. We talked about exactly what's going to happen before this earnings, right? When was it? It was right here, actually. So we talked about everything that was going to happen on NVIDIA, and everything we said worked out to the absolute point. Maybe not the cent, because obviously I'm not that crazy, but to the absolute point. So again, the information JP and I put out here is valuable, and it's based on our experience. Doesn't mean we're always right, not by any means, but I'm just saying you can listen to it, you could disagree with it, and you could go observe and make your own, whatever, right? I can't speak. But you could see here that NVIDIA is below its 200 moving average, which on the 200 daily moving average, which theoretically means it's undervalued in a short-term basis. But I mean, it really depends here. So, I mean, the great way to figure out where you would possibly want to average down is pretty simple. You could look at previous major lows. So for NVIDIA, that's going to be like, this low back here, or this low into here, right? And this low down here in the August flash crash. So those are the 3 levels. And you could see, even though these lows are there, like NVIDIA knifed right past them, right? So what is another great way to do it? And of course, my answer is going to be the fib levels, right? Fibs are great. Fibs are absolutely phenomenal. Fib retracements just tell you where human nature is going to most likely bounce. So we could see here, we are already past the 0.382, right? So that means already we're breaking the bullish trend that we had before, right? That's what that means. When you break past the 0.382, the trend is no longer bullish. So let's turn on the 0.5. Where's the 0.5? The 0.5 is going to be all the way down at 82.54. Where does 82.54 come close to? Well, that's almost close to the previous lows back in April 2024. So this, to me, if I like NVIDIA, this to me is where I would want to personally buy shares for my NVIDIA position. Does that mean I go balls deep in shares here? Absolutely not. There's no reason to, because I'll show you an example. Let's go to Microsoft and let's go all the way to 2022, right? You could have bought here. You could have bought here, right? You could have bought here, but you could have bought here, right? What do these three boxes have in common? All of these boxes were preceded by sell-offs afterwards, because none of these were really waiting for confirmation. You're just trying to lower your average, which is again completely fine. It's up to your risk. But let's say you have a softer risk approach. You don't want to take on that much risk. You have limited capital. You want to make sure you want to get a good entry. You don't want to deal with downside. You wait for the confirmations to align. So you could see here, the confirmation you could have waited for is it bounced off the 200 moving average, the daily moving average, no, weekly moving average, sorry. And then on top of that, eventually you got the weekly 50 moving average to be finally lower than the price, which then means that Microsoft was theoretically bullish. So you could have gotten in here and your overall performance compared to these three positions would have been much better theoretically, because on these three positions, these would have helped you bring your average down, right? Theoretically, these two positions only would have helped you bring your average down, but you would have had to size light on these because you don't know how much the market's going to go down. But when you get indications like this, theoretically, again, theoretically, you can size heavier on this position compared to these positions because you expect a longer lasting rally, because you have, for example, the stock above the 50 weekly moving average. So here's you can, this is another way you can look at it. So same thing you could apply, because I'm not going to go through each stock. I'm very tired right now. I did like hours of research, and I got to talk to my wife too. So that's that. So yeah, hopefully that helped when it comes to any long-term approach. The indicators I have for the weekly moving averages is, if you go to TradingView, if you press indicators, all I typed in was moving averages. And JP has a really good video on moving averages. You should watch that. Oh my god, I can't type. Oh my gosh. Look at this. And then this is the one I got. It was the moving averages 50 and 200. And it goes according to each day. It's not like it doesn't just go according to daily, right? So each time frame you look at, it adjusts to the moving average of that time frame. So when it comes to long-term investing, you always theoretically want to look at the weekly, right? And what does the weekly show here from Microsoft? We're not too far from our 200 moving average, so maybe we could possibly wait for it to test that, right? And if we see it bounce off of it, okay, that's a theoretical good position to add on. Again, I don't need to go into a deep position for that, right? So, that's a good thing. Let's say eventually the 50 moving average has a sharp decline, and what you see is similar to over here. You see the stock go like this, right? And this, and eventually it gets above the 50 moving average. How is this not a good entry? Right? Even if let's say it goes up and it comes down, that's fine. You followed a plan, and this is again a long-term account. So this gives you confirmation. This gives you a cheaper price. So figure out what you want, figure out how much capital you have to work with, and do what you need to do. I will tell you, I don't usually say this, but I will tell you my personal room for long-term investing. I typically do not like crossing, and I don't. This is usually under a paywall where I show this stuff. But for example, this is an account challenge I'm doing for one of my long terms. It's a 260K account, which I grew from 70K last year to 260K. So no, I'm not just down $22,000 on the account. I grew the 70K account to 260K last year, and now this is the statistics it's showing for this year itself, right? So I reset the account to 260K, and these are the statistics I'm showing. So these are one of the accounts I trade for my long term. And you can see here, it shows the breakdown of my portfolio. And what do you see here? Do you see just one big bubble or a few big bubbles? No, you see diversification. If I break this down, look at this. What do you see in common here? None of these percentages pass 8%. That is a personal rule I have, and you can have your own personal rules. I do not like surpassing 8% of my portfolio in any individual stock. So what this means is I need to carefully average, size on my initial entry and any average down or average up I have afterwards. That's why usually what I would follow is, if it's like a riskier stock or if it's a really great entry, my initial entry, again, this is just my way of doing things, would be 4%. And again, I'm going to show you something I showed on a one-on-one, which was paid. Hopefully I didn't delete it, because that would suck, because I need to redraw everything. Okay, great. All right, so here's what I showed the person I was on the one-on-one with. I told you my rule of 8%, right? So I'll show you how exactly I did it with Baba. So Baba, with one of my accounts, not this account, with one of my accounts, I first initially entered back in 2023 for this account with 4%. Back over here, I entered, we're not going to talk about that because I'm too tired to figure out all the percentages and do all that research. But I entered initially at 4%. Why did I enter at such a high rate instead of 2% of my portfolio? Because I was just confident in Baba and I knew I had a good entry. So I just wanted to get in. So 4%, right? Not too heavy. Baba came up, we hit the previous high over here. So I'm like, you know what? I don't mind reducing my risk here. I reduced it from 4% of my portfolio to 2%, right? That's why I chose -2. So my position size went from 4% to 2% because I reduced it by 2%. And then when it came down, I added only 1% of my portfolio into Baba. What I mean by is my thing went from 4% of my portfolio to 2% of my portfolio to now 3% of my portfolio. It came down here, it then became 5% of my portfolio. It came over here and it hit my max, which was 8% of my portfolio. From here, I did not add any more. Even if Baba came down, I thought to myself, it's okay. I don't need to worry about that. I'm not going to do anything. Baba short squeezed here, even though I was very, I was very tempted to sell over here, and I did on some accounts, but for this specific account, I did not. So it was a dumb decision. It was pretty dumb, and I'm sharing here with you my mistake. I should have technically sold half of my position. I could have added again here, but I didn't sell, and Baba came down. But the reason why I still stuck with this position and I didn't exit is because on the weekly, this is a weekly chart, right? Yeah, so on the weekly, you could see we've had higher lows. So this was still a very bullish sentiment, right? So I kept my position. Look at this. I gave you this entry. I gave you guys that entry. I gave you guys that entry as well. I even gave you this entry. So you guys can't complain to me about Baba. You can't. All right. But you could see, lo and behold, Baba went from $80 all the way to $150. My average was phenomenal. I'm not boasting. I'm showing you what I did. My average was around like 77 or 74, something extravagant like that. So 74 all the way to 150. You could see there was no reason for me to hold on a big amount of my risk. I reduced from 8% of my portfolio to 3% of my portfolio. And now in my long term, I actually added more of my Baba to my Baba position. So yeah, so if I actually go back to this website over here, you could see Baba, if I could find it, where's Baba? You can see Baba is down only to 1% of my portfolio, even though I just added over here on the week. I added on Friday. I added Baba shares. It's only 1% because we're in a bear market. There's no reason for me to take the risk. Also, because I am in Baidu, right? I'm in Baidu as well. I have unfortunately been, averaging down on this, but it's still a good setup, right? It's still creating higher lows on the weekly, even though it's making lows in the short term. It's still creating higher lows. Again, long term, you need to have a bigger perspective. I can't stress this enough. Bro, you ain't gonna be lasting here if you're gonna be I don't know why I said almost weeaboo, because that has nothing to do with this. But you're not gonna be here lasting in a long-term account if you're just looking at things in a short-term trend. Easy way to do this, just go to a line chart. Just simplifies everything. Shows you where the higher lows are and everything like that. But Baidu is across all my long terms my heaviest position. But look at it, it's only 7%. That means I still have room. If Baidu were to come down to, this is the last place I'll average down, by the way. If Baidu were to come down below 77 and it were to come to this low right here, that is the last place I will add on to my Baidu position. I don't care if Baidu goes down to 65 and it looks like the greatest and it skyrockets upwards. I'm not going to be regretful, because my plan is I'm not going to risk more than 8% of my portfolio. I have my invalidation points for Baidu. If it makes a lower low on the weekly, I'm not going to like that. I'm going to wait for a rally up and I'm going to sell into strength. But you could see here, 7.32%. That means I have still room to make it 8% of my portfolio, which I will add if it reaches down to that low point. And that's it. I'm not touching Baidu again until it reaches my targets. And you can see where my targets are. My passive target would be the 200 moving weekly average, which is 123, which is again a phenomenal, what's it called? Phenomenal target. Because if you see, even though I started this account recently, I'll show you what my average is on Baidu. Let's see. It's $90, right? So 90 to 90. Oh, look, it even shows my buys and, look at that. So Baidu, right? 90 to 120. Where's 90? That's 39%. You can't complain with that. And that's if you want to be passive. You could see where my long-term goals are, right? I hope it reaches 247. That'd be freaking amazing. But I want to be passive here, reach 181. But we've seen, again, I'm not saying this means you go put, that doesn't mean you go balls deep into, these stocks, these Chinese stocks. I just have seen the performance it had before, and I'm being very calculated. Understand this. I'm being very calculated with my risk. I'm sizing appropriately, and I'm using that. I don't care if my portfolio, if my position on this 260K account is down 1K. That's, I'm following my rule. Where are some mistakes I made? I unfortunately sized very heavy into SoFi and AAL, right? I should not have sized these heavy, even though they're down at 2%. Look at the drawdown that PayPal and SoFi had. This was a dumb mistake on my end, because I know I'm on a risk-off environment and I sized a little bit too heavy. I should have sized only 1% of my portfolio into PayPal and SoFi, right? And if I did, I'll be in a lot less drawdown, because look how much it lost on this account, right? The drawdown is 34% on AAL, and then SoFi it's down. It shows 5%, but it's down. It's down 10%, right? So, yeah, that's how you would really go according to that. That was a really long explanation. All right. For long-term accounts, what time frame do you look at? Asking for a 15K account specifically. Really depends on what your goals are. If you're trying to sorry, something perked my interest there. If you're trying to grow like a long-term account that's a low, maybe, again, if you're trying to buy and hold, then of course you would want to look at the bigger time frames like weekly and monthly. But if you're trying to hold for, only a few months or a year, something like that, daily is okay. But I find, like, when it comes to long-term investing, there's no issue really waiting, in my experience, for weekly confirmations when it comes to a weekly time frame. So yeah. Do you think tariffs will be a good long-term effect for the U.S. economy? Well, I could tell you this, regardless of my opinion of Trump, because you guys know my stance on Palestine, tariffs have not historically shown to have negative outcomes long-term to the stock market. Does this mean the U.S. economy? That's a different question. I can't answer that question. I don't actually know that answer. I only know regarding the stock market. When it comes to U.S. economy, in other sessions, we have great people you can ask. You have JP, of course, you can ask when it's his sessions to talk. We also have Tom, Randy. They only started recently trading, a few years ago, like 4 years ago, 5 years ago, but they're very educated. You can ask them for their opinions. We also have sometimes, occasionally, this really big whale named Bonk that comes on to our live sessions, which you can ask as well if he's ever on. But he's really not on that much. But JP is a good person to ask. Tom's a good person to ask. Randy's a good person to ask. But that's all opinions, right? If you want more factual based stuff, again, you have things you can look at, like Grok. I think Grok is personally one of the better AIs when it comes to research. ChatGPT, I guess, is more better for like image image generation. You guys can disagree with me, whatever. But the reason I like Grok is just because it pulls from Twitter posts and also live time data. So use that to your advantage. You can literally go and ask this question and then tell it to look at the current data and explain it to you like as if you're a dummy. And you can learn a lot from that. You need to rename to the market goat. I've thought about rebranding, but I mean my brand is so big. I'm the most followed Discord trader. Sticking to the market bishop, even though, I could have been the market king, but I felt like it just doesn't sound nice as the market bishop. And market goat, yeah, it sounds nice as well, but there's a little humility when you name yourself the market bishop. I wanted to name myself the market rook, but then I sounded like a guy in a playground, right? So I wanted to have a little mix of ego boost and humility. So I chose the market bishop, and I guess I'll stick with that. That's why my it's funny when I first started posting on Discord and I started using these bots, because I'm the first one who created the bots for Discord where people post their trade ideas. I used to have, because I used to penny trade first. I used to have a bot named, I don't know why I'm going off task. I used to have a bot named The Rook, which posted my penny trades. And then I had, which you guys see, of course, right now, which is the pawn, which shows all my, what's it called? All my day trades and swing trades when it comes to options. And I actually used to have a long-term account bot, which used to be named the Market Knight, right? So it's pretty cool. I had a nice thing going, but I just couldn't manage all those things because of college and personal situations. Blue chip stocks, unfortunately, I don't know what you're referring to here. When you have big moves on high beta, if you could clarify, please. When you have big moves on high beta, you look through the big watch list to see what's not getting hit as hard because IV could be lower. Yeah, big moves to the downside. And because, yeah, so the safe havens usually would not be on the higher current IV percentile rank. So then you're safer on that way, right? So that's why. Robin the Hood. Yeah, at least for one I don't like Robin Hood, flat out. But one thing I will say is okay, is it gives I'm hiccuping a lot, is it gives people who don't have that much money to work with an easy introduction to the stock market when it comes to long-term approach. I think Webull also has fractional shares. If you find a better platform than Robinhood to do fractional shares on that's had a history of being in the stock market, by all means, that's something you could possibly look on. But Robinhood it's somewhere to start if you haven't started. It's really easy to open up a Roth IRA with them and stuff like that, I believe. Again, I haven't used Robinhood in a while, so. Sorry for dumb question. Are halts bad? I mean, they're bad in terms of showing that the market is declining at a very fast rate. They're bad because when they resume, it doesn't mean it'll completely stop everything. But they're good because sometimes when a halt happens, it allows panic to settle just a little bit and plans to be formulated. And when they're formulated, there's just a little bit more of logical decision being made, which causes for less sporadic movements in the stock market. Damn, I didn't know dollar cost averaging. I will find you a very good image for it right now. Hold on. Give me 1 second. Bear with me. I will show you an amazing picture for it. All right. Just give me 1 second. Stick with me. This was posted by a guy named Dividendology. He's a good account to follow, actually, if you're trying to build a long-term account. And you know what? Since you guys actually have a lot of questions about long-term, I will make a live session soon about long-term accounts. And I think that will be a huge one. Oh, here it is. So it's not showing anything groundbreaking. But instead of trying to time the bottom, you could just do that, right? I posted the image in the chat over here. If you just keep on buying like this, eventually, you could. The way dollar cost averaging work, it doesn't mean you dollar cost average when Nvidia is at all-time highs. No, you dollar cost average. Usually, when it comes to stocks that don't have dividends, when it comes to dividends, then that's fine. Dollar cost averaging is fine because you're still receiving the dividends and you're only increasing the amount of dividends you get. When it comes to high beta stocks such as Nvidia, Microsoft, Apple, Netflix, Meta, these things you don't want a dollar cost average when they're all-time highs. You want a dollar cost average when they start getting at lower, cheaper, discounted prices. And this picture kind of shows it, right? When it gets low, you start just dollar cost averaging. When it goes high, you can keep dollar cost averaging, and then when you know it's in a bullish trend, you could keep on dollar cost averaging if you want, or you can move it to another undervalued position. So that's the power of dollar cost averaging. You don't really need to manage your portfolios as much, and it's only here and there. And again, the wheel strategy is just the rich person's way of dollar cost averaging while collecting premiums, and you do have to just obviously put in a little bit more time into it. If you were to start over again with a large capital and have little knowledge, where would you recommend starting to learn? Today was very informative for me, and I'm hungry to keep learning. Well, bro, of course, live sessions, nowhere else, right? But by the way, if you guys ever doubt our intentions here, if you want to figure out where we benefit from this, I'll tell you up front. I'll be completely honest with you. The biggest benefit we get is growing our Twitter profiles and our YouTubes, because that leads to other businesses that we have growing. So that's, there's a saying, right? Nothing is ever free in this world. That's absolutely true. This is technically not free because, you're benefiting us in a certain way. But I can tell you for a fact, live session has been free for years, and I've been doing this for years, and I did genuinely create live sessions for a good purpose. My belief on any business or anything in general is if you put people, members, and customers first, if you put their well-being first, and you look to give them value, they might indirectly not benefit you, but you're going to find a benefit in that. So that's my whole reason for live sessions, right? I'm teaching you guys because I also really hate seeing you guys lose money. I'm Indian, so maybe you could chalk it up to that and say, hey, Kevin's Indian. He doesn't like when people lose money for dumb reasons, because I'm stingy. But I also do care, and I do hope you guys are learning because, you can literally, you don't have to even follow us on YouTube, Twitter, whatever. Just attend the live sessions, watch the YouTube videos, and you'll definitely learn a lot more. So live sessions is great. There's a bunch of good YouTubes out there, but there's a lot of bad ones. That's one of the reasons why I created this live sessions to begin with. Here's an answer that a lot of you guys should do. If you're not freaking reading a book, I'm severely disappointed with you. Just read a freaking book, man. There's no reason you should not read a book. Here's a book that you could read that's not related to trading. I think it's called The Five Rings. Read that. That just talks about discipline and hard work. It's from a samurai freaking centuries ago. So it's freaking sick hearing a samurai from centuries ago when being cheesy wasn't a thing, right? So it's not like you look at him being like, oh, you're being cheesy. Nah, this dude, he was freaking raw and he talked about everything. Phenomenal book. I think it's great because you can relate a lot of the lessons you learned there into trading. So it's a very good book to read. There's a lot of other good books you can read. Mark Minervini, or whatever his name is, he has a book named Super Performance, How to Trade Like a, what is it? I have the book somewhere here. Trade Like a Stock Market Wizard. Really great book. Read that. So yeah, read a book and don't read I'm sorry if any of you guys have read this and if you advocate for the book completely, you can disagree with me. This is just my opinion because I'm a pretty monotone guy. I think books like Trading in the Zone or anything like the Mark Douglas books, anything that has to do with trading psychology, I think they're just complete waste of time. If you really need to read that book, go ahead. I'm not going to stop you from that. If you suffer from having bad trading psychology, go ahead and read it. I personally think books that provide information and value along the way are a lot more informative and a lot more beneficial than books that are just focusing on psychology and just making you try to feel better. I'm a raw kind of guy. If on my downfalls, I don't expect a person to tell me, "Oh, it's fine, you're gonna be fine." No, I expect them to tell me what's wrong, right? And I like books that tell me where I'm wrong. Even till this day, I know a shit lot about the market, but I know for a fact I know nothing in the stock market at the same time. So I still read books, like this book, the book by Mark, right? I'm not sponsored by anything you guys are hearing right now, by the way. Trade Like a Stock Market Wizard. I know half of this. I know 90% of what this guy is telling me in this book. I'm still reading it because there's still 10% I don't know. And it's great to learn, right? Like when you read stuff is much better than watching. I am telling you. It is much better than watching. It's just, and don't buy an ebook. Buy a physical book. If you guys want, I'll go find the books that are really good. There's also some phenomenal books that I read in my first years of trading that were made by Richard Wyckoff. Forgive me if I said it wrong, JP. And I wouldn't say they're outdated because he's kind of like the father of price action. And you guys know me, I'm a price action trader. But yeah, I wouldn't say it's outdated, but obviously volatility has increased and a lot of things have changed. But if you want like a more technical kind of book, he has a lot of phenomenal books you can read. Really great books you can read by Richard Wyckoff. So feel free to read that. If you want more up-to-date books, again, the Trade Like a Stock Market Wizard book, even though that talks about stocks, you could still apply that to options because obviously you're trading a stock option, right? So books are great. Don't read some of the bullcrap that's coming out recently unless you really have to. Again, personal opinions. I'm just not a guy who needs to feel better, you know. even if my wife gets mad at me, I don't need her to be like so soft with me, right? I just need her to tell me like, hey, you did this. I didn't like this. Maybe you shouldn't do that. It's wrong. And I'll be like, okay, all right, fine. I'll learn from that. If I get a feeling like, oh, it's okay. A lot of people do this. It's fine. If someone doesn't nail the fact that I'm being an idiot at that point, without even knowing it, I'm a person I'm not naturally greedy, but I will naturally take advantage of it without even knowing. And as humans, you have to realize we naturally take advantage of things without even knowing. We naturally take advantage of people who make us feel good because we feel okay with what we're doing, even though we're told we're doing it wrong. If they kind of coddle you and say, oh, it's okay, you're fine. Why do you think we repeat those behaviors? Because in our head, even though in the back of our head, you feel like, oh, I don't know why I'm going on this rant. I gotta move on. All right. Yeah, watch the VIX video. 200. Yeah, yeah, JP has a good video on moving averages, so watch that. What website is that to track the portfolio? I'm not sponsored by them, but if you're going to open this, don't open it just yet, because then live sessions will create a link and you can use a referral link. I'm not sponsored by them. I'm not going to push them out here. I wouldn't say it's fully accurate, but it's like 95% accurate. It's called Stock Unlock. You could check them up. It would be great if you guys were to wait for me to put out a referral link so then you could support, the live sessions. That would be pretty cool, right? But it's a great website. If you want to sign up for it, go ahead. You don't have to wait for us. Stock Unlock, you could sync your brokers to it, or you can manually enter in like your actual buy dates and sell dates. It only calculates shares. So this is strictly only for a long-term account. If you have options on it, it just does not recognize it. So Stock Unlock is that website name. Again, not sponsored by them. Baidu is 5.3%. Yeah. What website? Okay. Thank you. Amazing. You're the bishop to my king. I've heard you say that so many times, man. Anytime anybody says this, I hear your voice. Market Bishop is superior. I know. I love the brand name, man. I don't think I can ever... Like, it's hard to make profile pictures. I freaking was an idiot, and I made a profile picture last week. And I'm a freaking Muslim man, and I don't know if... I messaged one of my Muslim friends on here on Discord, and I'm like, hey, is my profile picture okay? He's like, dude, that looks so satanic. And I was like, oh, fudge, man, what am I doing? So it's a little hard to make profile pictures with the Market Bishop kind of profile picture, but I like the brand, so I'm just gonna stick with it. Sultan of the market, I wish I would have thought, but unfortunately, when I became a Muslim, I was not on Discord, so I converted way after, because I was a Catholic first, so that's why I reverted. That's why I chose somewhat of a Catholic name. But you know what, Sultan of the market, even though it's not fully a Muslim name, I will consider it. If I were to change, this is one of the names I would change to. The Market Sultan. That sounds nice. Kevin, could I ask you how long it took you to build your account from 200 to 260K, and what amount did you start with? Did you withdraw at specific intervals or when you reached a certain milestone? Okay, so first of all, last year I grew the account from 70K to 260K. That was just one of my accounts. And to grow that to that amount, it took a year, right? Because I started in the beginning of the year, I grew it, and I ended it in January. But you have to realize, not trying to make you feel inferior, but my skills and talent when it really relates to trading is a lot higher than yours. Not because I'm smarter, but because I have more experience and time and more knowledge about it. So I can't say you're going to replicate that. But I've also talked about in the risk management video, I talked about setting time intervals and goals for yourself are sometimes very detrimental. So just just the stage, what you should just be doing right now, in my opinion, is just trying to grow, learn, survive, and then as the years go by, then you could focus. And the book, The Stock Market, Trade Like a Stock Market Wizard by Mark, this guy has been trading for 30 years now. His first 10 years were subpar, absolutely subpar. But one thing he did that's so great, because he's one of the greatest traders that's ever been in the U.S. equity market. One of the things he did that no one else did was he studied day in and day out. He had a similar ritual to me. Like, I was obsessed with the stock market. I still am. I still try to learn something new every single day. I try to read a book every single day related to stock market, right? So, did I withdraw when I reached a certain amount? When I had my options account, which was not a long-term account, yes, in the beginning I did, but then I realized, since I could risk, because I was young, right? So my parents took care of me. They didn't put money into my trading account, not by any means, but they, of course, I was privileged enough to have such great parents. They raised me well, and they were able to, take care of me financially until I, went to college and everything, or before college. So that during that time, I thought to myself, okay, I don't need this money right now. I can risk to let the compounding effect grow, which again, we talked in the risk management video, and I kept the money in there, and my account grew over time. Maybe if you're in a worse financial situation than I was at that time, you know, setting a limit, like let's say if you're 10K account, maybe you're like, okay, for a whole week, for a whole month, any profit I make by the end of the month, any profit I make past, let's say $11,000, I will, withdraw that amount. And then let's say the next month comes, you're like, okay, any profit I make past $12,000, I'll withdraw that amount. So you're still kind of growing your account, but you're possibly withdrawing the profits you made, which also returns the investment which you made on the account in the first place. So if you have the financial stability and you can risk, then the compound effect take its course. You don't have to technically withdraw. Again, it's up to your risk tolerance. But if your financial situation is pretty dire, and I've said my personal opinion is, when your financial situation is pretty dire, maybe trading's not the first thing you want to do, because your emotions are pretty high, and you're not going to think of the long-term stuff. You're going to be thinking of the short-term stuff, and not to get money quickly. But if you are in a situation where you do need money, then withdrawing is not a bad idea. Is a stock like BR? Oh, yes, BR. Oh my God, BRKB. Tell me if I'm talking too loud. Is a great stock. Unfortunately, it doesn't pay dividends. Most safe havens pay dividends. That's a very crucial part. So you know what? I'll do a live session soon on safe havens, because I think you guys need to learn this. But again, you don't even need that live session. You could go to the watch list I have. Every single watch list I have has a dividend yield of 2% or above, or 1% and above. So dividends are a very crucial part to being a safe haven, and emphasis on stable, growing dividends. Those are a big factor of a safe haven. So I can't outright say, because Berkshire does not have a dividend. But one thing that I will say about Berkshire is Berkshire Hathaway does a phenomenal job of managing their assets. And if you look at this, let me show you something. Tell me which one looks better to you. SPY's weekly chart or Berkshire? Berkshire, right? So if you want growth and stable growth, this is the one. But this doesn't provide dividends. So will this perform really great in a bear market? You could do the research yourself. I personally haven't, so that's a really good question. I'll look into it afterwards. But you should definitely look at it beforehand. Yeah, follow us both on YouTube, not YouTube, Twitter. If you don't have our YouTube, you're crazy. I'll show you our channel right now. Here's our account. Man, I'm getting tired, so I'm probably gonna wrap this up soon. And JP, if you want to stay on, you can, but it's getting pretty late. Let's see.
No, I lost
You're in the past.
internet.
Yeah, no worries. Okay, so yeah, we have our YouTube. We have videos. I started live sessions years ago, like 5 years ago. But I only started recording 3 to 4 years ago, so we have a bunch of videos on here. Even old topics, I'm gonna look to redo them at a more updated version because, of course, the volatility changed from 2022 all the way till now. So watch our YouTube. If I expect for SPY to be 40 down, oh my gosh, 40% down over the next year, will the long-term account continue to grow, or should I just stick to cash? Well, you kind of answered your own question. I mean, if it's a long-term account, what do you care if SPY goes down 40 or 60%? Your question is not, how much down is it going to go? Your question is, am I too over-leveraged in SPY, or am I too over-leveraged in my positions? And if I'm not, is there valid points where I can enter more at reasonable areas, right? And then the next thing, as you guys saw in the in this website thing, is you don't see my ads being pretty drastic, right? They're all, like, if I add, let's say for example, let me pull up okay. Let's say for example I want to add a position to my target, right? Target is only 1.22% of my portfolio. If I want to add target right now, I'll pull up target's chart. I'm not adding, even though it's a great spot and this dividends on target are phenomenal, right? You could see the dividends have been growing year per year. And the reason, well, let me tell you this. I'm so sorry. I keep on going off task, but the reason why growing dividends is important is because growing dividends fight inflation, and the whole purpose of dividend stocks is to fight inflation. Because as time goes, if you especially reinvest your dividends, and again, I guess I really need to make a video on long-term and dividend stocks and safe havens. If you keep on reinvesting your dividends back into the stocks that paid out the dividends, you're looking at eventually in the future, 20 or 10 years down the line, that account that is primarily dividends that have safe havens or just really growing dividend stocks like Target, those stocks are going to pay you at such an amount that you're actually going to get a decent amount per year. You could almost sometimes retire off of it. And compared to a traditional growth account where, let's say Nvidia, yeah, of course you could buy Nvidia on long term. I would never say it's a wrong choice, but you have to eventually sell Nvidia to take use of that profits, right? On dividend stocks, you don't need to do that. The years that you're growing that account, you just keep on reinvesting dividends or you buy more shares. And then when it comes to a point where you retire, or just 20 years down the line or 10 years down the line, those dividends are going to be paying you enough that you don't need to close any of your positions. So that's the great thing about dividend stocks. But let's say, going back to my example here, Target's only 1.22% of my portfolio. If I were to add Target right now, you'll only probably see this jump up from 1.22% to maybe 1.8 and maximum 2% of my portfolio. And 2% is really pushing it, right? So you could see how I'm adding on to these positions. I don't care that Target's down at its 52-week low. I'd much rather it just come up, become bullish, and then I don't mind adding there, because this one for me is a dividend stock. So yes, the entry matters, but it really doesn't matter so much. A great dividend stock that I'll say is SCHD. This thing is a monster. It has outperformed the S&P 500 when you add in the dividend reinvestment. I'll show you right here really quickly, and I think I'm gonna wrap it up because I'm insanely tired and I need to eat dinner. My wife's just freaking staying up for me. So you could see here how much the you could see for, let's say, from 2015. The only pay attention to this white line on the top and the which one? And this no, wait. What? Never mind, I was wrong. So what SCHD provided is it didn't outperform the SPY, right? Because the SPY is this white line over here, because obviously SPY is more of a growth ETF, which is SCHD is more of a stability growth. But you could see here in this box that at the peak, SPY did reach with the dividend reinvestment, SPY did reach 260%, but SCHD was not far behind with 193% return, and that's just price. So let's say it reached all the way to that point, you're like, okay, all right, I'm done. I've been investing all these years. Let me just, collect my dividends now instead of reinvesting it. SPY doesn't give you those massive dividends, but SCHD will. So that's the power of dividends if you get the right stocks. And again, don't just go with high dividend stocks, because those high yielding dividend stocks are not always the greatest option because they depreciate in price. Just follow you on YouTube and Twitter and Discord. Where you call post, I look forward. Thank you for all. Yeah, of course. Don't buy it. Kevin is right. Which one? I don't know what you're talking about. Oh yeah, don't buy the. What about Rich Dad Poor Dad? Never read that book. I'll read it and I'll let you know. Think and Grow Richer, Much Better. I've never heard this book, Adrian. I'd love to read that too. So I'll read both of these. She gives the top 5. Yeah, well, what about VPA? Never read that. I'll read that. Yeah, Randy humbles me. Sure. 3 religions. I know, dude. I know. I've been trading for 12 years. I started at the age of 12. I'm 24 now. I started in March. Freaking 12 years ago. It's crazy. On my birthday. My birthday was in March, so it hit the 12-year mark. Crazy. Do you mix your long-term with your short-term trades? No, I separate them. I have like over 8 accounts. I have literally one account for day trades, one account for spreads, one account for iron condors, one account for swings. Maybe you don't need to go that far out, but I just like being very organized. But I would personally say it's never a good idea to mix your long-term funds, an account, long-term funds with your short-term funds, right? There's nothing wrong trading short-term. If you have like, let's say some people have like 250K to play around with, maybe 235 or even 240,000 you could just put into long-term, and maybe like 10,000 you could use for short-term trading, right? But if you mix those two, then you never know when you could cross the line. Oh God, no, I will not use that as my profile picture. My voice is really relaxing. Okay, so my wife is not crazy. Thank you. Do you do this every week? Yes, we do. Unfortunately, all of March I was vacant because I don't need to go too much in details. I don't need any sympathy, so please don't say anything. But I had some personal issues I had to deal with when it came to my grandmother. Good thing is she's somewhat better, so that's good. Good news, thank God. So JP was such a huge help. He literally pulled out of his ass all these topics, and he just like taught them perfectly. I'm behind on the upload, so I will upload what he talked about. But this guy is on like pretty frequently. Usually our schedules was, as you could see how busy I was. I didn't even update it past February because March was just a complete shit show. Trading wise, we were phenomenal, but February it just wasn't. March wasn't a great personal month for me. But you could see here, like we usually held sessions on Monday and Thursday. Only reason I did it today on the Sunday is because, and I'm talking about structured, these are structured topics, right? Live sessions might happen here and there, like if JP wanted to talk about something important. And like today, I decided I needed to take the time to take, out of my day to do it today instead of tomorrow, because, tomorrow, what I said today is probably very important for tomorrow, especially with the IV contraction. So that's why I thought it's important today. So it's usually Monday and Thursday. That's when the structured lessons are. So since we did one today, don't expect a structured one tomorrow. If JP's up for it, only if he's up for it, because this guy's been putting too much energy into this, he can do one. He can, come on and talk about a market recap, and I'll come on. I just won't really be talking as much because I got a lot of stuff to do. Is it me or the sound is very choppy? Was my sound choppy this entire time? Was it? Because that would suck. Oh, it was. Damn, I hope that doesn't ruin the recording. Hopefully you guys were able to understand though, right? Hopefully you were able to understand, because I hope some of you guys. But all right, yeah, I guess it was. If you guys want the recording right away, You could see it on Twitter, because on Twitter it's being streamed right now. So the second the stream ends, it's gonna post a recording. If you guys want it on YouTube, you'll see the. Hopefully, I could post it by tomorrow, but it's getting pretty late. I usually sleep by 10:30 or 11. So I don't know. Hopefully, I can wake up early tomorrow at 6 and edit the video and post it. Well, thank you guys for coming on. JP, he didn't even have to come on, and he still came on. So thank you guys. If you guys want to stay on, if I don't know if Randy or JP wants to stay on afterwards. If you guys don't want to, you don't have to. But pleasure talking to you guys. I'm gonna go eat dinner. All right. Good night. Thank you.